Yeah. Are you guys back? Okay. Let's start. Now, next topic is about rights issue. Yeah. Please see. Rights issue. In fact, with respect to rights issue, in the standard, there will be a decently lengthy formula which is given. With couple of steps, you can actually avoid that formula. I'll make you solve these questions without using formula. It will be useful for you. And do not panic that if not through the formula, will I be awarded marks and all. This has been tested multiple times and marks are being awarded even if we adopt this method. So whenever problem contains a rights issue, please adopt this method. The first thing which you are supposed to do is calculation of fair value post rights issue. Second, calculation of bonus component in rights issue. Once we are done with these two parts, we can easily go ahead with the question whenever there is a rights issue. Okay. So I'll give you with an example. I'll do it with an example so that you can easily follow. Say there are right now on 1/1, there are 10 lakh equity shares outstanding and a rights issue is announced for 1:2. That means one right share for every 2 shares held is issued on 1/10/14, say. Okay. And rights price, exercise price happens to be 20, whereas market value before rights was 35. Okay. So with this info, how do we calculate weighted average number of shares is what the question is. I'll show it. Please see. So as I earlier told you, first calculation is calculation of fair value of share post rights issue. Post rights issue. Now, whenever we are supposed to calculate post rights issue, I already have existing shares. I already have existing shares, which is for every 2 shares, I have a value of 35 rupees per share. That is 70 rupees I have a value. And for the rights share, for each share, the shareholder is bringing 20 rupees, which is, it becomes 20 here. The value for the company's valuation goes by up by 20. Now, when you see the number of shares outstanding after rights issue, there are 3 shares and the value per share has become 30 rupees per share. Okay. So, post rights issue, the value per share is 90 divided by 3. 90 is the value for the company, divided by 3 is number of shares outstanding. So it becomes 30 rupees per share. So that means a share which was valued 35 rupees before rights issue has become 30 rupees after rights issue. Why did it happen? Because there is an element of bonus inside this rights issue. Okay. There is an element of bonus inside this rights issue. That means if I issue the same shares to a new shareholder, I would have issued for 35 only. Only because I am issuing the same share to an existing shareholder, I am foregoing some money which the shareholder has to bring in. Which means I as a company has to contribute out of my own reserves for that particular share. Hence, there is an element of bonus inside it inherently. So I'll have to find out what is the amount of bonus inside that particular shares. So what we will now do is, second part what we do is calculation of bonus element. Bonus element in shares. Now let us see in full the number of shares outstanding and all. Now, let us calculate bonus element in the right shares which we are issuing. Sorry. So right now we are issuing against 10 lakh equity shares, we are issuing 5 lakh equity shares as rights issue, right? So when I issue 5 lakh equity shares at 20 rupees, I would actually get 100 of value, 100 into the company. The same 100, if I issue at post issue price of 30, I would have actually issued only 3.33 lakh shares. Yes or no? So that means inside this 5 lakh shares, there is a bonus element of 1.67 lakh shares. Okay. So identifying this bonus only is important for us. Now, while you prepare Vayne's table, what happens is this 1.67 will be added to first line, that is 1st of January or 1st of April, whatever be the beginning date in the problem. And for the other number of shares, that is 3.33 lakh shares, you would add it based on chronological order, the date on which you have taken that shares. So automatically, excuse me. So automatically your Vayne's calculation would be proper. Okay. So this is the same calculation which is given through a very lengthy formula in standard, which can be cut short and understood this way. I'll quickly once again explain this. Please see. First, what we are supposed to see is fair value of share post rights issue should be calculated. How do we calculate it? For the existing number of shares, what is the value per share? That is, for the existing number of shares, what is the value per share and what is the total value for the company? And at the same time, for the number of rights shares which you are issuing, how much do you collect and what is the value for the company? When you total both the values divided by number of shares outstanding rights issue, you get post rights issue share price. Post rights issue share price. And then we are supposed to calculate the bonus element. How do we calculate bonus element? Number of shares issued through rights into rights issue price, you get a value. You get a value. The same money, if I issue at 30 rupees, that is post issue price, post rights issue price, I would have actually issued only 3.33. So inherently, I have a bonus of 1.67 lakh shares. Okay. So this is the calculation. This is the calculation what we do to understand post issue rights, post issue share price and bonus component. So as we do problem, you will be able to see this calculation once again. Do not worry. So let us take the question now and solve. Yeah, rights issue, 7th question, please see. Given below are the details of equity shares of MN Limited during 13 and 14. Equity shares fully paid up on 1/1/2013. 1000 shares, value 10 lakhs, 10,000. Rights issue on 1/7/14, 100, 2000. Closing market price on 30th June 2014, 35. Price of rights 20. Net profit after tax for the year ended 31st December 2013, 2200. Reported basic earnings per share for the year ended 31st December 2013 is 2.2. Net profit after tax for the year ended 31st December 2014 is 2400. Calculate basic earnings per share. Okay. So let us go ahead with our calculation. Let us start. First, what we calculate, as I just mentioned, first calculation required to be done is fair value of post rights share. Fair value of post rights issue. Fair value of share post rights issue. So right now, if you observe, I have 1000 shares at 35, which is 35,000, and I am going to issue 100 shares as rights at 20, which is 2000. Total comes to 37,000, and number of shares outstanding are 1100. Okay. So fair value post rights issue is equal to 33.63 per share. This is first step. Okay. Next, number 2, calculation of bonus element. Calculation of bonus element. How do I calculate bonus element? I am issuing 100 shares at 20 per share. I would actually get 2000. To get the same 2000, at 33.63, I would have actually issued only 2000 divided by 33.63. I get somewhere around 60 shares. I'm taking directly round off. So I have a bonus element of 40 shares. I have a bonus element of 40 shares. So this is the calculation which we are supposed to prepare and keep aside. This is the first working note. Okay. Once this is done, we can go ahead with preparing Vayne's table. While we prepare Vayne's table, bonus will be first taken to one minute, guys. While we prepare Vayne's table, please take date, particulars, number, cumulative number, weights and product, date, particulars, numbers, cumulative numbers, weights, products. In this, on 1/1 opening balance, you are supposed to take dates, not just the 1000, including bonus element which we have issued in this year, because bonus is given to shareholders who were there in last year also. Okay, so 1040 will be taken. Cumulative is also 1040. And next, on 1/7, I have announced rights. 1/7, I have announced rights issue. I have given 60 only now. 60 only now. It has become 1100. And weights, if you see, this is for 6 months, this is for 6 months. So it's going to be 6240. Here it is going to be 6600. Total becomes 12,840. This is 12 months. Weighted average number of equity shares is equal to 12,840 divided by 12. I get somewhere around how many shares? 1070. 1070 shares. Okay. So this is the question, and he says basic earnings is he has mentioned as 2,400 in the current year. Okay. BEPS in current year it is 2,400 divided by 1070 would be 2.243 per share. Per share. Okay. We are also supposed to do for previous year. Okay. Now last year BEPS last year, I would have shown it as 2,200 divided by 1000. That is how it would have been shown in last financials, but not now. Okay. But now what we are supposed to do is, we are supposed to take it with the revised number of bonus element. So earlier last year I would have shown as 2.2. Restated BEPS for previous year would be 2,200 divided by 1,040. Reason, these 40 shares are presumed to exist last year also. These 40 shares are presumed to exist last year also. Hence, we are taking it to the previous period. So automatically last year's revised basic EPS would be 2.115, I guess. 115, yeah, 115 or 12. 115 per share. Okay. So this is the calculation which you are supposed to do. Please see once again, you need not by heart the formula at all. For rights issue, don't by heart the formula. Simple 2 steps. One, calculation of post rights issue price, then calculation of bonus element. How do we do it? Existing number of shares into before rights issue rate. You get a value. Same way, number of rights issue into rights price, you get a value. Total of the value divided by total number of shares outstanding, you get new value, new rate, which is the post issue rights, post issue price, post rights price. Okay. And calculation of bonus element is number of shares which are being issued for bonus into number of shares issued for rights into rights issue price, you get a value. The same value take down again, number of divided by the bond rights issue, post rights issue price, which is 33.63. So you get number of shares issuable, number of shares issuable for 2000 rupees, and then excess number whatever is given is the bonus element. So here in this case 40 is bonus element. I hope I made it clear for you guys. So let's go to next problem. Take out 8th question. Eighth question, please see. From the following data, compute basic earnings per share. Net profit for the year ended 31st December 2014, 11. Net profit for year ended 2015, 15. Number of equity shares outstanding prior to rights issue 5. Last date for exercise of rights issue 1st March 2015. Rights issue of 1 share for every 5 held at 15 per share. Fair market value of share prior to rights is 21 per share. So all information is available. Let us start with the answer. So please see. So calculation of post rights price. Post rights price. So existing shares, he says 1 for every 5, no? So let us take it like this. For 5 shares, earlier the value was 21 rupees, 521's 105, and rights shares, for each share it is being given for 15 rupees. So the value is 15. Total value for the company has become 120 for 6 shares. 120 for 6 shares. So fair value post rights issue is 120 divided by 6, which is 20 per share. Which is 20 per share. Now, calculation of bonus element. Bonus element is now I am issuing 1 lakh shares here. He says the existing shares are 5 lakhs. So against 5 lakhs, I'll be issuing 1 lakh shares. Okay. So 1 lakh shares I'm issuing at 15 per share, which gives me 15 lakhs. The same 15 lakhs I would have actually issued, if at all I have issued for 20. Okay. If at all I have issued for 20, I would have actually issued only 75 lakh shares, 75,000 shares, in which case I have given away a bonus of 25,000 shares. Okay. So my bonus shares are 25,000 shares. So with this, your, post rights issue value calculation and number of shares of bonus element calculation is over. Now let us go ahead with preparing Wayne's table. Let us go ahead with preparing Wayne's table. Date, particulars, numbers, cumulative numbers, weights, and product. So the beginning of the year, which is 1/1, I had opening balance in which I should take along with bonus element. So existing is 5 lakhs and bonus element is 0.25. So it is 5.25 lakh shares. Cumulative is also 5.25. Weights, let us take later. In the chronological order, next transaction happened on 1/3. Rights issue happened. Number of shares is 0.75. Cumulative is 6. And the weights now we can take 2 for first transaction, 10 for second, 10 for second. Okay. So multiplication, it is 10.5 lakhs and 60 lakhs. So totally 70.5 lakhs divided by 12. Okay. Veins would be 70.5 divided by 12, which comes to, thank you, 587,500. Now, here again, he has asked you for basic EPS and all. Let us calculate that. BEPS for current year, let me do first. For current year, it is 15 lakhs divided by 587,500, which comes to 2.55 per share. 2.55 per share. And BEPS for previous year, earlier calculated was, that is actual. Okay, calculated was 11 lakhs divided by 5 lakhs, which would be some number. Please tell me, guys. 2.2 or 4.3? All right, 2.2 per share. And now revised BEPS of previous year would be 11 lakhs divided by 5,25,000. 5,25,000. 1.87. Is that correct, guys? Okay, 2.09, it seems fine. 2.09, I'll take 2.09 per share. So this is how you calculate basic EPS for current year. This is the thing. And revised basic EPS for presentation, that is comparison. Comparable number in the financials would be 2.09. So it indicates that from 2.09, it has increased to 2.55. Okay. So with this, basic EPS problems are over. Let us move to diluted EPS. Now, what does diluted EPS mean? Diluted means at times when shares are issued, they might be issued for consideration other than cash. They might be issued for consideration other than cash. That means I may have my employees, like how we discussed in the beginning days. There could be ESOPs which could be given to employees on satisfaction of certain criteria. I issue shares to them, or there could be convertibles in the company. That is, your preference share capital or debentures or some other bonds could get converted into equity, or there could be some commitments in the company, because of which I will have to issue equity shares for past services received or past consideration received. In such cases, there is possibility of my earning per share getting reduced from the existing number. Why will it reduce? Reason is very simple. Today, though I issue shares to them, I would not have any inflow of cash, inflow of funds which are being utilized for furtherance of business from today. Hence, there would not be any possibility of increase in profits, but number of shares in the denominator might get increased. Hence, these are the reasons as to why there could be a dilution in EPS. Now, having said about this, predominantly the factors for diluted EPS can be put into three. Number one, convertibles. Number two, options. Number three, commitments, or there could be some other contracts, commitments or contracts. In such cases, we would issue shares for no consideration or for past consideration. Now, considering these three, what should be done in the problem whenever there are there is diluted EPS? First thing supposed to be done is diluted EPS calculation starts with where basic EPS ends. Wherever basic EPS has ended, that is the starting point for diluted EPS, and that would be taken as a base for us to calculate diluted EPS. Now, to calculate diluted EPS, first and foremost important thing required is calculation of incremental earnings for each diluter. Okay, we are supposed to identify incremental earning for each dilutable element. What is this incremental earning? That means there are possibilities where when I convert few instruments, for example, in the balance sheet, I have preference share capital. If I convert preference share capital into equity, in future, I do not have a requirement to pay dividend on this preference share capital, yes or no? So there is some earning which is getting added to equity shareholders because of this conversion. So what is the amount of incremental earning I am making by converting this preference share capital into equity is what you should observe. Similarly, I have debentures in my company. These debentures, if I convert them into equity, hereafter I will not have any requirement of paying debenture interest at all. That means by converting this debenture into equity, my interest cost on debentures is no more, and my shareholders will have more profits after tax. Yes or no? So these are ways in which we try identifying incremental profits earned due to this conversion, and we will give a ranking for all these incremental earnings. Now, say I have 4 or 5 types of convertibles. One, preference share capital. Second, debentures. Third, I have a ESOP in my company, because of which I will have to issue 100 equity shares to an employee. And apart from this, there is a bank commitment. There is a bank commitment which I did not satisfy. Hence, the banker has asked me to issue 1000 shares. Against this 1000 shares, I have already taken bank loan long back. I did not repay him. Hence, he is asking me to issue the 1000 shares today. Now, when this is the situation, say the incremental earnings for ESOPs happen to be 0. The incremental earnings from bank commitment happens to be 0, because there is nothing which these will save now. Okay. By converting preference shares into equity, I have a saving of say 1.2. And by converting debentures into equity, I have a incremental profit of say 2.4. Now, once you calculate incremental earnings like this for each of these shares, each of these convertibles, what you are supposed to do is you are supposed to rank them. The ranking will be first rank for the least contributing category. Now, in this, if you see, ESOP and commitments are least contributing, that is 0. So hence, I will give first rank to these. For which one should I give in either of these two? Anything you can give, doesn't really matter. Okay. Next, the next rank would be, in the chronology, in the reverse order. So for 1.2, I would give second rank. For 2.4, I would give third rank. This is the sequence in which you give ranking for the incremental earnings. Once ranking is done, we will start calculating diluted earnings per share. Okay. Now, as we solve the problem, you will understand how we are doing it. So for now, this explanation is sufficient. We will go ahead and look through the problems. As we solve, you will be able to understand how we are calculating the diluted earnings per share. So with this intro, let's pick up the questions. Please see 9th question. Given below is capital structure of PQR Limited for calendar year 2015. Particulars: numbers in lakhs amount. Equity shares outstanding on 1/1/2014 1000. 10% convertibles each to be converted into 8 equity shares 200. Net profit after tax 1000. Basic earnings per share is 1. Assume tax rate is 38.5. Calculate diluted EPS. Also compute diluted EPS if interest rate is 12% and conversion into 6 equity shares. So there are 2 questions given here. Let us first solve the first one, then go to the second one. Okay. So first thing, as I earlier told you, for a DEPS problem, for a diluted earnings per share problem, base is basic earnings per share. So basic earnings per share, he has directly given that it is 1000 divided by 1000, that is equal to 1. Okay. Now we are supposed to calculate incremental earnings. Okay. Incremental earnings have to be calculated. So let us calculate. Number 1, for convertible debentures, let us calculate. For convertible debentures, he says the debenture interest is 10%. Please see, the debenture interest is convertibles interest is 10%, and the number of debentures outstanding are 200, and value is 20,000. So 10% of 20,000 is 2,000, and he says it is debenture, hence there will be a tax rate of 38.5. So I'll have to take after tax debentures interest savings, because for equity shareholders, profit available is always after tax only. Okay, so for convertible debentures, let us calculate 10% of 20,000 into 1 minus 38.5, 1 minus 0.385. So you get some number. Please tell me that divided by, he says number of equity shares issuable for this is 200 into 8 for every one debenture. So I get something. So please tell me what it is. So incremental earnings would be 10% of 20,000 is 2,000. I don't think it is 770 and all. Please check once again. 2,000 into, okay, yeah. So 1,230 divided by 1,600. You get incremental earning is equal to 0.768. Okay, I'll take that. 0.768 is the incremental earning. Now, considering this, we are supposed to calculate diluted earnings per share. So diluted in this problem, luckily there is only one convertible, so you don't have a requirement of ranking. Directly you can go ahead with diluted earnings per share. So DEPS is calculated like this. Please see, whatever in the numerator you have for basic earnings basic earnings per share, please take that 1,000 plus incremental earning in this particular instrument, that is 1,230 divided by existing number of equity shares plus converted number of equity shares. So by issuing these number of shares, my earning per share has fallen down from 1 rupee to, can you please tell me the answer now? 2,230 divided by 2,600. Okay. So 0.858 is the diluted earnings per share for me. Okay. So that means my earnings per share has fallen down from 1 rupee to 0.858 because of this convertible. This is what implication you should draw out of it. So I hope it's clear. Now let us calculate for the second scenario what he has given. Second scenario, he says interest rate is not 10%, but it is 12%. 12%, and number of shares issuable are 6 instead of 8. Okay. So let us calculate for that. Scenario 2. Again, incremental earnings per share has to be calculated. Incremental earnings per share is equal to 12% of 20,000 into 1 minus 0.385 whole divided by 200 into 6. Okay. So it gives me 1.23. Yeah, thank you. 1.23. So can you please tell me numerator, denominator also, so that it will be, I'll have to use it in my DEPS workings. Numerator is, okay, 1476 divided by 1200. That gives me 1.23. So diluted earnings per share is 1,000 plus 1476 divided by 1,000 plus 1,200, which is 1.125. That means because of this conversion, my earnings per share is not diluting. This is a case what we call as anti-dilutive, because the earnings per share did not fall down. It has increased up. It has gone upwards. The moment it goes upward, you cannot call it as dilutive. It is only anti-dilutive, which means standard says whenever you see a circumstance such that the earnings per share after considering convertibles is anti-dilutive, you need not disclose about such information. You need not disclose about such information. If we disclose to the extent where it is diluting, it is sufficient, because we adopt something called as conservative principles in accounting. Okay, considering the principles of prudence, if we disclose till where it is getting reduced, that is sufficient. Okay, so this is what in the second scenario, it is anti-dilutive. Explanation for that. Now, having explained this, let's go to next question. Yeah, please see. The capital structure of a company is given below. Equity shares 1000, 9.5% convertible preference shares 100, shares each convertible into 6 equity shares, 12% convertible debentures 500, each convertible into 4 equity shares, share options, each options carry 1, exercise rate of 100 shares at I think it's continuation there. You are supposed to read it along together. Share options, each option carry exercise rates of 100 shares at 15 per share, average fair value of equity 20, net profit after tax attributable to equity shareholders is 1500, tax rate 38.5, dividend distribution tax is 10%, compute diluted earnings per share. Okay, so this is the question. Let us start solving. In this problem, you have 3 types of instruments, 3 convertibles. So we are supposed to calculate incremental earnings for all the 3, and then only take a call. Okay, so now let us start with first of all, basic earnings per share. He has told you about it. BEPS is equal to 1500 is the earnings he has mentioned, divided by 1000 are existing number of shares. So 1.5 is the basic earnings per share. Keep that aside first. Now let us start with incremental earnings per share. Incremental earnings per share. In that A, for preference shares, let us do first. Preference shares. Now for preference shares, he says there is a dividend of 9.5%. There is a dividend of 9.5% convertible. And he also says there is a dividend distribution tax of 10%. That means I have a saving of preference dividend and also a saving of dividend distribution tax. So both I'll have to bring in here. So let us see how it would be. So for a preference share, I'm going to have 10,000 into 9.5%. So I get, I think it is 950 plus 10% on that 950. That is, which comes to another 95. Okay, plus 95. So total savings are 1045. 1045 divided by number of shares issuable would be 6 equity shares for each. So that is going to be 600. So my incremental earnings are 1.125. Is that correct? 1.125. Okay, 1.74 it seems. 1.74 I will take. So this is first incremental earning. So let us do for the second part. Second incremental earning is for your debentures. For debentures, he says the interest rate is 12%. Okay, debentures, he says interest rate is 12%. Okay, 12% debenture interest rate, and tax rate he says it as 38.5%. So considering both these information, we are supposed to calculate profit after tax. So it's going to be 25,000 into 12% into 1 minus 0.385. So you get some number divided by number of equity shares issuable are 2,000. Okay. So please tell me first values, the numerator value please. 1845 and denominator is 2000. So it's going to be 0.9292. I'll stop there. Okay. 0.92. I'll stop there. Now let's go to the third calculation, third thing. See, with respect to options which I have given. Options. For options, there is no incremental earning. There is no incremental earning. So it is 0 divided by, he says I will be issuing 100 shares or something he has mentioned. But what we are supposed to do is, in this you are supposed to see what is the amount of bonus element. Okay. I think it's, he has stated the price at which they will be buying. Now, please see. Each option carry, one is there, exercise rate of 100 shares at 15 per share. Okay. Average fair value of equity is 20. Okay. So he says, similar to your bonus calculation, what you did in rights issue, you are supposed to adopt the same thing here. Out of 100 shares, he is contributing something for 100 shares. You need to see what is the contribution he has made and how many shares I should have issued. But you have issued 100 shares. Okay. So for this, what you are supposed to do is calculate bonus element in bonus in options. Okay. Right now I am issuing 100 shares for 15, where I get 1500. For the same 1500, if I have to raise by issuing at 20, I would have actually issued only 75 shares. That means I have issued 25 shares for no consideration. So this is only my bonus element. Okay. Now, for the bonus element alone, I'll have to see what is the incremental, income or incremental profit. Okay. So now 0 is my incremental earning, and 25 are the shares which I am giving for no consideration. Now, what about the remaining 75 shares? He has already pumped in money into the company, and that money is used by us to earn this profit, whatever we are showing now. That means for that 75, we should not be bothered about. We are supposed to be bothered about only shares which are being given for no consideration today. Okay. So today I am giving away only 25 shares without any consideration. Hence that would be considered. So 0 divided by 25 would be 0. Don't tell me infinity and all. It doesn't work here. So now you have got all 3 incremental workings done. Out of these 3 incremental workings, first rank will be given to 0. Okay. And second rank will be given to debentures, and third rank will be given to your preference shares. Okay. So this is the sequence of ranking which we have done. Now you are supposed to calculate diluted EPS. So as I earlier mentioned, for diluted earnings per share, base is basic earnings per share. Base is basic earnings per share. So DEPS at rank 1. Let us do it at rank 1. So that is equal to 1500 plus 0 divided by 1000 plus 25. Okay. So how much is it? So that is equal to 1500 divided by 1025. So I get 1.463. 1.463. That means it is dilutive. 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 That means my options are absolutely dilutive. Next, let us go to rank 2. At rank 2, you are supposed to take base as not BEPS. You should take base of rank 1 calculations. That means 1500 plus rank 2 earnings you have already calculated here as 1845. 1500 plus 1845 divided by rank 1's veins, that is 1025 plus. In rank 2, you are issuing 2000 shares. Okay. So 2000. This gives me how much? Answer please. Okay, 1.106 it seems. 1.106. That means at this juncture also it is falling from 1.463. 1.106 let me take. So at this juncture also it is dilutive only. At this juncture also it is dilutive only. Okay. And let us go to the last part, last rank, at rank 3. At rank 3, if you see, I have a total of, at rank 2, I have a total of 3,345 plus divided by 3025 plus 1045 and 600. 1045 and 600. So I get a value of 1.211. Mark this important. Mark this important. This is anti-dilutive. Anti-dilutive. Why is it anti-dilutive? Because it has raised upwards from 1.106. It is anti-dilutive because it has raised upwards from 1.106. Hence, it is anti-dilutive. That means in the presentation in my financials, if I disclose up to rank 2, it is sufficient. Rank 3, I need not disclose at all. Okay. Financials are to be prepared only based on conservatism. Hence, we will prepare only up to rank 2 and rank 3 could be ignored while presenting. But for your calculation purpose, you should do this. You should do this. Okay. So this is how you do when we have multiple convertibles and diluters in a problem. Okay. So with this, let us move to next question. Let us move to next question. Last question. Yeah. I'll read out the last question. Please see. Calculate basic and diluted earnings per share. Income after tax 50,000. Weighted average number of equity shares outstanding is 10,000. He has directly told you, lucky enough. Tax rate 40%. options to purchase 1000 equity shares at 8 per share. These options were outstanding during the year. Options to purchase 2000 equity shares at 1.3 per share. The average market price of the equity share during the year was 10. 7% convertible bonds, 200 bonds, each convertible into 40 equity shares. The bonds were outstanding during the year end, entire the year. The bonds were issued at par, 100 per bond, and no bonds were converted during the year. 4% convertible cumulative preference stock at per 100,000 shares issued and outstanding for the entire year. Each preferred stock is convertible into one equity share. The preferred shares was issued at par and no shares were converted during the year. So this is the info which is given. Using this information, we are supposed to calculate basic and diluted earnings per share. So if you can, someone do, please tell me what is basic earnings per share. I'll wait for 1 minute. I'll wait for 1 minute. Please tell me what's basic earnings per share. 5. Okay. Any other answers? If you say 5, please slap yourself. You'll wake up. You'll wake up. 5. It's no. It's not 5. Now, yeah, 4.6 correct. Thank you, Mr. Tirumlai. Yeah, Gautam. So it's 4.6. Basic earnings per share is profit available to equity shares divided by weighted average number of equity shares. So profit available to equity shares is not always PAT. It's not always PAT. So from PAT, you are supposed to work somewhere. He has given 50,000 as PAT. It's profit after tax, from which deduct preference dividend. Preference dividend is 4,000. Is 4,000. So it is 46,000 pace divided by weighted average number of equity shares. It is 10,000 already given. So your basic earnings per share is 4.6 per share. 4.6 per share. Now, having done this, let's go ahead to calculating incremental earnings. Second step is calculating incremental earnings per share for all those factors which he has given. In that, first one is options category 1. Options category 1. There are 2 categories of options, hence I am mentioning as category 1. So first category options, my earnings in any option would be 0 divided by number of shares which I am issuing for no consideration I will have to bring in. So again, just like previous problem how we did for options, adopt the same methodology. I have given away 1000 shares at 8 rupees. So my value what I get into the company is 8,000. The same 8,000 I would have actually issued for 10 rupees, in which case I would have issued only 800 shares. In which case I would issue only 800 shares. So the bonus element is only 200 shares. Okay. So 0 divided by 200, it is supposed to be taken as 0, not infinity. Okay. So 0 is option 1. So evident that this is the first rank holder. Okay. Second, options second category. Option second category, irrespective of category, always for options, the earnings would be 0. Denominator, I'll have to work out. So I am now issuing 2,000 shares at 1.3. At 1.3, the value I'm issuing for is 2,600. But the same 2,600, I would have actually, if I have issued for 10 rupees, I would have issued only 260 shares. 260 shares. So there is a bonus element of 1740 shares in it. So 0 divided by 1740, again 0 only. Again 0 only. Now don't ask me which one should I give rank 1. Either way it is okay. Either way it is okay. While you calculate also, if you take both of these together and do also, there is no wrong. It's okay, absolutely fine. Next, moving forward, for third instrument which he has given there, which is convertible bonds. Convertible bonds. Let's calculate for convertible bonds. He says whenever it is a convertible bond, that means it is an expense what I incur, interest expense which I incur before tax. So taxation should be kept in mind. He says interest rate is 7%. He has got how many bonds? He has got 200 bonds convertible into 40 each, and 1000 is the bond face value. Okay, so 7% of 200 into 1000, you get a value. Out of that, 1 minus 0.4, 1 minus 0.4 whole divided by 200 into 40. 200 into 40. Please tell me values also. I want values also. I want values also. Divided by, it is 8000. I want numerator. Okay, 8400 it seems. Okay, 8400. So it is 1.05. Thank you. Next, last category, preference shares. Preference shares. I have 4% preference shares, no tax required. He did not tell you about dividend distribution tax also. Directly take 4% of 1000 into 100. 1000 into 100, and they are convertible into 1000 shares. So it's going to be 4000 divided by 1000 shares, which is 4. Now at this juncture, let us rank them. Ranking, if you see, first rank holder is these two zeros. 1 and 1 you can give, 1 and 1. And second rank holder happens to be convertible bonds. Third rank holder is 4. Now, with this info, let us go ahead and prepare diluted earnings per share. For diluted earnings per share, what I need is the basic earnings per share, which we have already calculated, which has come to 4.6. So from 4.6 as a base, we are supposed to do for rank 1. So rank 1, there are 2 participants. Let us take them as it is. It is going to be 4600 plus 0 divided by 1000. 10,000 plus 200 plus 1740. 1740. You get a value of okay, so it has become 3.852. 3.852, and at rank 2, it is 4600 plus 8400 divided by, this is 2940 plus 8000 shares. So here it is 3.852. 3.852 is previous one, no? So it has fallen down from 4.6. Hence, this is dilutive. Here, please tell me. Yeah, 2.728. Again, it is falling down, dilutive. So rank 3, it's going to be how 2940. So, sum up all these 1000 plus 200 plus 1740. Okay, sir. So at rank 3, I have 13,000 plus 4,000 divided by 10,940 plus 1,000. How much is it? Okay, 2.78. So here it has become anti-dilutive. Why? Because from 2.72 it has hiked up to 2.78. Hence it is anti-dilutive. So this figure need not be disclosed. If we disclose till 2.728, it's sufficient. Okay. So with this standard is also done. As I earlier mentioned, the difference between this and Ind AS is only one particular area, which we call as extraordinary item. That too, it's not because of this standard. There is first standard AS1 in Ind AS 101, which says extraordinary items should not be part of your financial statements. Hence, considering that particular standard, it is adopted in this standard also, and extraordinary items are ignored under Ind AS. Okay, so that is the only difference between AS and Ind AS in this particular standard. I hope it was fruitful. Let's go ahead to next standard. Let me pick up one more interesting one. Let's go to taxes. Yeah, there is a question here. Shouldn't the bonus element in options be considered for basic EPS computation like we do for rights issue? Of course, yes, we should. But when these are not yet done. No, see, we are calculating diluted EPS for future prospectives. It is not yet done. It is possible that they will be done in this year. They are not yet done. The moment it is done, it becomes past. Okay. If you see, there is one of the problems in which we have done where there is convertible which got converted. Okay. If it is converted, it forms part of basic EPS itself. If it is not yet converted, in future there is possibility that this can happen. That is what you are trying to convey here. Okay. All right. So with this, let us close AS 20 and Ind AS 33. Let us get into taxes. Now, AS 22 and comparable Ind AS for this particular standard is Ind AS 12. Either for AS 22 or for Ind AS 12, the base standard is IFRS only. The base standard is IFRS, where it would want the entity to identify the possible future tax payables and savings in taxes in the balance sheet. Okay. However, Ind AS has adopted whatever IFRS has given as it is, but AS 22 has tweaked it, has completely modified it to match Indian ecology of taxation. That's all. Okay. Now, under AS 22, the approach what we adopt is what we call as P&L approach, and under Ind AS and IFRS, it is called as balance sheet approach. Balance sheet approach, and it is actually more practical when compared to P&L approach. Let us talk about that part little later. Now, for now, to understand how P&L approach works, let us take an example and do, say, in the current financial year, one second. One sec, guys, some issue with this screening. Yeah, sorry guys, I'll start afresh. Some issue in the screen. Yeah. So in the current year financials, I have a revenue of 100, expenses of 50. So my profit before tax happens to be 50, and tax expense is 30%. Say it has come up to 15, and my profit after tax is 35. This is what my income statement as per income tax is. Now, this 50 has got two components. One is a non-cash expense component and cash expense component. Non-cash expense component happens to be 15 and 35 happens to be cash expense component. To the extent of cash expense component, it is allowed under Income Tax Act. Non-cash expenses only to the extent of 15 are allowed. But in my books of accounts as per Companies Act, I have a revenue of 100. I have a non-cash expense component of actually 25 and the cash expense of 35. So my profit before tax as per Companies Act happens to be 40, and tax expense continues to be the same 15. I have a profit after tax of 25 in my books of accounts. Now, someone who sees my books of accounts P&L, he would understand that I have a greater expense in the year and less taxation in the current year. Yes or no? But fact is, my whatever depreciation I had here, this will be charged to depreciation under Income Tax Act on a future date. In the future, this 15, this 25, the difference between this 15 and 25, 10 will be charged to taxation in future years. That is, there is possibility for it to get attracted to tax in a future year, and in future I will be paying lesser tax. Okay. Today I am paying more tax of 15, where I am actually supposed to pay, say on 40, 30% would be only 12. I am supposed to pay only 12, but I paid 15. So there is requirement for me to showcase that in the books of accounts, I have paid more tax today to the tune of 3, and this will be eligible for me in future. That is, this will be a benefit for me in future is what we have to disclose in the financial statements. Hence, the impact called deferred tax effects have come into picture. Now, having explained this intro, what are deferred tax effects? Deferred tax effects can be broadly categorized into 4. In fact, only 2, because there is possibility of increasing and decreasing, it becomes 4. What are they? Creation of deferred tax liability. Second, creation of deferred tax asset. Third, reversal of deferred tax liability. Fourth, reversal of deferred tax asset. So these 4 are what we call as deferred tax effects in the financial statements. This standard tells us how accounting for such deferred tax has to be done in the books of accounts. Okay. Now, with respect to taxation, in our schedule 3, if you see, there are two important parameters for taxation. Taxation can be broadly categorized into two. One is current tax, second is deferred tax. We are talking about this particular aspect here. Current tax is the actual tax which you have paid. The actual tax which you have paid, and we are not discussing about that here. We are only talking about the deferred tax which we show in our financial statements. Okay. Now, how is deferred tax effect calculated? As I have just mentioned, under AS 22, deferred tax effects are calculated using P&L approach. That means we will try to identify those items in the P&L which have a possibility of reversal in future, or there is possibility of getting attracted in tax future, or not getting attracted in tax future because of getting attracted now itself. So all such items are considered to calculate deferred tax effects in the financial statements. Now, what all type of items can be there? The transactions can be broadly categorized into items which will have temporary timing differences and permanent timing differences. So that means items under P&L can be broadly classified into two. One is called as temporary timing differences. Second is permanent timing differences. Items having permanent timing differences. First of all, what is a permanent timing difference? Item which does not have an impact in future in taxation at all. For example, I have taken in my books of accounts, that is TCA, Companies Act books of accounts, I have taken an expense of 3,000. Say it is a contribution made to some some political party, but Income Tax Act says any contribution to political party is not allowed to be deducted as an expense. Okay. So in such case, say I'm just giving you an example. In such case, this will not have a timing difference at all. That is a permanent timing difference. We should not have any DT at all in it. We will not have any DT in it at all. But when it comes to temporary timing differences, what sort of timing differences do we see? There will be few cases where I might charge few items into expense in my TCA, that is under Companies Act books of accounts. I may charge something to my P&L, few expenses. For example, PF contribution by employer. I did not actually pay, but I have taken it as an expense by providing for expense. I have shown it as a liability in my current liabilities in my balance sheet. I did not actually pay. Still, under Companies Act, you are showing it as an expense. But under Income Tax Act, what Act says is, unless until you pay, that is only on cash basis, you will be eligible to get some deduction in your P&L account. So that means there is possibility for this to get implied into your tax P&L on a future date. So till the time it is implied, you have a timing difference with your items in the P&L. So only for those items which have a timing difference, only those items will have deferred tax effects in the financial statements. Otherwise, there are no deferred tax effects at all. So having said about this, now let us go ahead and see few questions. How problems should be solved here. Okay. Now, with respect to problems, while calculating all deferred tax effects are to be calculated on a holistic basis. That is not year after year. It should be calculated from inception of a particular item. For example, what does that mean? I purchased a machine. And this machine cost me 100. Be it under books of accounts, it is 100. Under income tax also, it is 100 only. Under books of accounts, my depreciation is 20, but under income tax, it is 30. Now, for the first year, I will be ending up paying lesser tax because my tax expense is 30 when it is supposed to be only 20. Okay, so my taxation expense will reduce. So which means I will be paying lesser tax today, which will impact me to pay more tax in future. So there will be a deferred tax liability which I'll have to create in my books of accounts for future periods. Okay, so this is first understanding. Second, whenever I'm calculating deferred tax effect, it should not be calculated only for the first year. That is, if at all it is an item which has passed through multiple years, you are supposed to take impact on a holistic basis. What is holistic basis? Say the same asset, first year this is the depreciation. Second year the depreciation here continues to be 20. Here it has become 25. Third year, here it continues to be 20. Here it has become 20. Okay. Now when we are calculating deferred tax effect for second year, you are supposed to calculate considering both the first and second years together. Okay. Under income tax, till date, I have charged to P&L 55, but under Companies Act, I have charged only 40. So for the difference, I'll have to calculate deferred tax effect. And second important, for example, if you are calculating in the third year, in such case, for all the 3 years under Companies Act, I have charged 60. For all the 3 years under Income Tax Act, I have charged 75. So for the difference of these two, I'll have to calculate deferred tax effect. Now, while calculating deferred tax effect, what tax rate should be considered? What tax rate should be considered? The tax rate considered for deferred taxes are not current tax rate, they are future tax rates. They are future tax rates. That means, anyways, this impact, deferred tax effects are going to be seen by us in a future period. Hence, the future tax rate adoption is more appropriate rather than adopting current tax rate here. Most of the cases you will be able to find future tax rate. If you do not find future tax rate, adopt current tax rate only. That's fine. Okay. Due to lack of information, we can adopt current tax rate, but examination point of view, in the examination, he would definitely give you what is future tax rate. Only that future tax rate has to be adopted in solving the questions. Okay. With this intro, let us start with the questions. Please take out first question. Thank you, Krishna. Yeah. So first question, please see. A company purchased an asset for 600 lakhs on 1st April 2015, which was fully depreciated under Companies Act. The income tax deduction shall be restricted to 20% WDV every year. Calculate deferred tax asset or liability that will arise in the books of accounts of the company for the year ended 31st March 2016, assuming prudence in estimation of profit for subsequent years. Tax rate is 30%. So let us start working. Now he says depreciation under books of accounts P&L till now is 600. So 600 is still now, and under income tax it is restricted to 20%. Okay, so we are supposed to calculate what is tax expense now and what would be the future impact on it. So any problem you see like this, any deferred tax problem, first write it as number 1, BOA P&L, that is BOA P&L depreciation. Depreciation till date is equal to 600, and tax P&L depreciation till date is, he says it is 20% of 600, so it is 120. Okay, that means when you compare these two in future, so today you are paying lesser taxes because your depreciation what you are charging to tax P&L is only 120. So in future you will be paying, right now you will be paying more taxes, which will eventually lead to less taxation in future. Okay, hence therefore in future less taxes will be paid. Less taxes will be paid. Okay, that means today you have created a tax asset. Okay, what it also implies is your taxable income. Your taxable income is less than profit before tax, what you have calculated. Okay, therefore less taxation in future. So in current year create DTA. Okay, now how much DTA should I create? DTA should be created with the percentage which he has given.
I can learn to understand.
Please don't learn. Now he says tax rate is 30% for subsequent years, and what is the difference between your 600 and 120? It is 480. On 480, 30% is how much? 144. Yeah. So for 144, you are supposed to create DTA. Okay. So create DTA. DTA will be 600 minus 120. The difference between these two into future tax rate 30%. That is equal to 144. Now entry would be DTA is an asset. Okay, DTA is an asset, hence DTA will be debited. DTA account debit to P&L account. You are affecting it from your P&L only. Okay, in your P&L you would show and create a asset in your balance sheet. So it is 144, 144. So this is how you do a simple problem. So let's go to next question. Second question, please see. ABC has pre-tax profit of 5 lakhs for the year 2015. It has a temporary difference at the end of 2015 that will reverse and result in taxable income as under. In 2016, 40,000, 2017, 70,000, 2018, 90,000. The tax rate is 30% for all the years, and assume that there was no deferred tax at the beginning of year 2015. Tax payable for the year 2015 is calculated as under. Pre-tax profit 5 lakhs, temporary timing differences 2 lakhs, taxable income 3 lakhs, tax rate 30%, tax payable 90,000. Calculate DTA or DTL and pass required journal entries. Okay. Now, first of all, what is he saying? He is asking you to tell what would be the deferred tax impacts in various periods. That's all. Okay. So let us do that. Now, in 2015, if you see, he would have written this entry called P&L account debit to provision for tax. P&L account debit to provision for tax for 90,000 because the tax expense in that year is 90,000. Okay. Now, you're supposed to see whether there is any impact in future. Okay. So in 2015 only we are seeing first. In 2015 financial year we are seeing. So P&L account debit to provision for taxation 90,000, 90,000 he would have passed an entry. With respect to deferred tax, we are supposed to see how much is the impact. Now in books of accounts P&L, till date he says there is no impact regarding this at all. Okay. So it is zero in books of accounts. But when it comes to tax P&L, there is an impact of 2 lakhs. Deduction in tax P&L is 2 lakhs. Okay. So in future, temporary deduction will be there. Temporary deduction which will be chargeable to tax. Okay. So therefore taxable income will be greater in future. Greater in future. Okay. Which means I will have to create DTL. DTL should be created. Why? Because deduction today itself I am taking 2 lakhs, which means I am paying lesser tax today. In future I'll have to pay more tax. So for the benefit which I have taken today, in future I'll be paying more taxes. So create DTL. DTL would be 2 lakhs into 30%. How did you get 2 lakhs? This 2 lakhs minus 0 into 30%. So that is equal to 60,000. Okay. So create DTL 60,000. Now out of this 60,000, see if there is any current DTL. Current DTL is equal to 0. Therefore, DTL to be created is equal to 60,000. So same value is 60,000. Current DTL to be created in the current year is 60,000. I hope you guys are able to understand. I'll repeat once again. In 2015, I have paid actual taxation of 90,000. For that, a current tax entry is passed. After that, for deferred tax effect, I have done this calculation. As per books of accounts, I have not taken any deduction till now in my books of accounts, 0. But as per taxation, I am eligible to take the entire 2 lakhs deduction in this year itself. I have taken. That means I am paying lesser tax today, because of which in future I will be paying more tax. So I will have to create DTL. The DTL would be 2 lakhs into 30%, 60,000. DTL should be 60,000. Current year DTL is 0. So what I should create is 60,000 minus 0, 60,000. Okay. So this is current DTL is there any DTL in your books of accounts? For now, is there any DTL in your books of accounts? If it is there, we will deduct that. If you do not have any DTL, completely create it afresh now. Okay. So this is what we do for first year. Okay. Now, what would be the entry for this? What would be the entry for this? Entry would be P&L account debit to DTL 60,000, 60,000. Okay. Now, let us prepare reporting format also for this. How does that appear? Profit before tax would be presented as 5 lakhs. He has given you in the question. Taxation impacts we are supposed to deduct. Adjust here. 2 items: current tax and deferred tax. Deferred tax. So current tax is 90,000. Deferred tax is 60,000. Both deduct, which is 1,50,000 deduct. So net for your profit after tax is 3,50,000. So this would be your presentation in the financial statements. Okay. So this is how you report it in the financials. Now let's go to next year, because this 2 lakhs benefit which you have taken in 2015 is spread over 3 years as a benefit. How did we get to know that? He has given you details of the taxable amounts in future. Please see this. Okay. So over these 3 years, I'll have to bring that benefit into my books of accounts. So let us do that now. In 2016, did he tell you about any normal taxation paid? Nothing. So current tax calculation nil, not required to do. He did not ask you to do. Let us not do. But deferred tax calculation you are supposed to do. Deferred tax calculation, please see. Now again, BOA P&L till date. Till date, it is 0. In books of accounts, P&L, it is 0. And under taxation, till date, that is 31st March 2016. Till date, if you see, I have a benefit of leftover only 1,60,000. That means 40,000 is considered. 40,000 is considered. So 1,60,000 only I will have a benefit now, because 40,000 is taxed. So, see, please see the question once again. He says that will reverse. So it has a temporary timing difference at the end of 2015 that will reverse and result in taxable income. So out of the 2 lakhs, 40,000 is taxed in 2016. That means I have a benefit of only 1.6 lakh now in this by the end of this financial year. So 1.6 lakhs is what I take. So in future, I will have to maintain a deferred tax liability now. So in future, I have to pay tax. Hence, deferred tax liability should be 1,60,000 minus 0 into 30%. That is equal to 48,000. Okay. DTL now is current DTL. Last year you have created no 60,000. 60,000 is current DTL last year which you have created. So that exists in the balance sheet. So deduct that. If you deduct it, you have to write off DTL to the extent of 12,000. I hope you are able to follow. If you want, I'll repeat once again. Please ask. I'll repeat once again. Please see. In the first year, I have created DTL for 60,000. Reason is in the first year I have paid normal tax of 90,000, which is current tax. Keep that aside. Current tax and deferred tax have got no combination, no relationship at all. Both are independent. While calculating deferred tax for the first year, I am supposed to see, are there any items which will get reversed in future? Reversed, or there are temporary timing differences in future. The question directly says a 2 lakh rupees of expense, there is a 2 lakh rupees of income, it has got a temporary timing difference. So to that extent, I'm supposed to calculate deferred tax effects. Okay. The 2 lakh rupees was not put to tax in 2015. Therefore, what happened? I have saved tax. I have saved paying tax in 2015. If I save paying tax in 2015, it means that in 2016, 2017, 2018, in future years, I will have to pay tax. So that is why we have created DTL in 2015 for 2 lakh rupees. On 2 lakh rupees, I have calculated 30%, which has come to 60,000. So DTL should be 60,000 in 2015, out of which I did not have any opening DTL at all. Hence, DTL which is created is 60,000. So for that, what entry we have passed is P&L account debit to DTL. This is the entry which we have passed, and in the P&L, this is the presentation in the financial statements. Okay. So first year got over. Coming to second year. In the second year, he says, out of the 2 lakhs which was not taxed in this financial year, 40,000 is getting taxed. 40,000 is getting taxed. That means on a holistic basis, we are supposed to see. That's what I have told earlier also. On a holistic basis, if you see from 2015 and 2017-16 together, if you see, 1,60,000 is not taxed. 1,60,000 is not taxed. So on that 1,60,000, what should be the DTL? How did I get this 1,60,000? 2 lakhs minus 40,000, which is taxed in the current year. Okay. 1,60,000 is not taxed. On this 1,60,000, 30% comes to 48,000. So I should maintain a DTL of 48,000. Out of that, I already have an opening balance of 60,000. So that means I need not maintain 60,000. If I maintain 48,000, it's sufficient. Hence, what I will do is I will write off DTL to the tune of 12,000. That is difference between 48,000 and 60,000, 12,000. Okay. Can't hear. It's not my issue. Others, are you guys able to hear? I'm sorry, not my issue. Should be your all right. So this is the impact what you're supposed to bring in second year. I hope I'm making it clear. Let us go to next financial year. Sorry, first of all, let us write how you will reverse this off. So right now, DTL already exists for 60,000. Already exists for 60,000, which you are supposed to reverse such that it becomes 48,000. Hence, 12,000 rupees I'll have to reverse. Entry for reversal will be to create DTL, P&L account debit to DTL. To reverse DTL, it is going to be DTL to P&L. And so entry is going to be DTL account debit to P&L 12,000 rupees, 12,000 rupees. Okay. So after passing this entry, let us show reporting also. Reporting I am doing only for your understanding. Examination, if he has not asked, not required to do. Okay. PBT, he did not give you, we don't know, take it into. Current tax, don't know, take it into. Deferred tax, take it as 48,000. Okay. So with this second year, it is over. Now, let us go to next year, 2017. In 2017 calculation, if you see again, he says income to the tune of 70,000 is accounted for. Out of 2 lakhs, 70,000 and 40,000. So total 1,10,000 is accounted. That means there are temporary timing differences only to the extent of 90,000. Okay. So BOA deduction till date is 0. Deduction as per tax P&L is 90,000 because 1,10,000 is taxed now. I still have 90,000 only. So 90,000 is what I have. So DTL should be 90,000 minus 0 into 30%. Okay, it comes to 27,000. Current DTL is equal to 48,000. Okay, so since it is more than what is required, we will have to write it off. Okay, write off DTL, which will be 21,000. Okay, so this is what's to be done for 2017. Entry again, the same entry, DTL to P&L 21,000, 21,000. Okay, next for 2018. In 2018 again, BOA deduction till date is 0, but under tax also it is 0 because everything got accounted. Everything got accounted in taxation also now. Okay, so right now DTE is equal to 0. Deferred tax effect, I don't have any deferred tax effect, so it should be 0. But right now DTL is 27,000, sorry. So what I'll have to do is, so this is current DTL. Current DTL is 27,000. So I'll have to reverse this off. That is write off. Write off. So it's going to be DTL account debit to P&L 27,000, 27,000. Okay. Okay. In 2018, as per books of accounts, it is zero only because everything got accounted in 2015 itself. In taxation, you are left with 90,000 that got taxed in 2018. Please see here. 2018, this 90,000 got taxed. So that means there is everything got accounted. There is everything got taxed. There is no separate deduction in taxation at all. Okay. Both the places it has become equivalent only. Both the places it has become equivalent only. Hence, it is zero in both the places. Automatically, DTE would be zero. Hence, whatever exists in the balance sheet, I'll have to reverse it off. That's all. Okay. Next. So let's go to next question. Third question, please see. AD Softex Limited has three financial statement elements for the year ended 31st March 2016. The book value and tax base value is given below. Equipment 2 lakhs, 1,20,000. Prepaid insurance 75,000, 0. Deductible for tax on payment basis. Warranty liability 50,000, 0. Calculate deferred tax effect or liability. Tax rate is 40%. Now, what is he trying to do? Trying to ask you here. He has given you three independent factors which may create deferred tax effects in your books of accounts. Okay. So you are supposed to analyze each of these independently and tell what would be the deferred tax effect for each of these in your financial statements. So let us do that. First, let us do for equipment. First, let us do for equipment. Now, he says equipment as per books it is 2 lakhs and as per tax it is 1.2 lakh. Okay. As per books it is 2 lakhs and as per tax it is 1.2 lakh. So that means depreciation under deduction under taxation is 80,000 more than books. Yes or no? Till now your book value is 2 lakhs but under tax it is 1.2 lakh. So you have deducted more under taxation when compared to books. Okay. So you can understand this otherwise also. Say I have purchased an asset of 5 lakhs earlier. Today the book value is 2 lakhs under books of accounts. The same 5 lakhs has become 1.2 lakh under tax route. So what happened here? I have charged to do depreciation to P&L. I have taken 3 lakhs as per books of accounts, but as per income tax, I have taken 3.8 lakh. That means I have taken more expense in my tax P&L when compared to books of accounts. Okay, so I would have paid lesser taxes in this financial year or over these financial years as I used this asset, which means in future I'll have to pay more taxes. No, I'll have to pay more taxes. So for that reason, you'll have to create deferred tax liability. Are you guys able to follow? Whenever a question is given to you like this, directly from assets point of view, if he asks, try to create an illustration. Say, I have purchased an asset for 5 lakhs in 2 years back. Over 2 years, I have written down 2 lakhs in my books of accounts, but under income tax, or else, I have written down 3 lakhs in my books of accounts and 3.8 lakhs in my tax P&L. That means I have charged more expenses in my tax P&L. Hence, I have paid lesser taxes till now, which means in future I'll have to pay more tax. Okay. So DTL should be created. So DTL should be 2 lakhs. So it's going to be 3 lakhs and 3.8 lakhs. Difference between these two, 80,000. 80,000 into future tax rate he has given us 40%. It is supposed to be 32,000. I should maintain. Okay. DTL should be is 32,000. Current DTL, he did not mention anything. Assume it to be 0. So that means DTL to be created in current year is 32,000. How do I create DTL? P&L account debit to DTL. Okay. So this is for equipment. Did you guys understand? Can we go forward? Okay. Next. Prepaid insurance. Now, if I am stating that there is prepaid insurance in my balance sheet, it means that it has not moved to my P&L, books of accounts P&L till now at all. Yes or no? Only because it is not charged to P&L, I am still showing it in my balance sheet. Maybe in the next year, I will show it as expense in my P&L account. But what income tax says is, whatever insurance is paid, immediately you are supposed to take full credit, irrespective of number of years. So now what happens is, prepaid insurance in books of accounts, I am showing 75,000. Under income tax, I don't have it at all. That means that 75,000, I have already consumed it in my tax P&L. Today, I don't have it at all. I have already consumed and I have paid lesser taxes today. That means in future, I will have to pay more taxes. Hence, deferred tax liability should be created. Okay. So deferred tax liability should be 75,000 into 30%, which comes to 40%, sorry, which comes to 30,000. Okay. $30,000. So entry here will be again, say same scenario. Deferred tax should be 30,000. Current DTL is 0. Hence create DTL. Create DTL. Entry would be P&L to DTL. 30,000, 30,000. Okay. Next. He says about warranty liability. Warranty liability. What is warranty? Warranty liability is basically I will have to bear that for my customers. So warranty liability exists in the balance sheet. The moment it is a liability, in future I may have to pay it. Okay. So what income tax says is there is no warranty liability at all. So everything is accounted. Okay. That means, take this as an example. Say Hyundai cars, they have collected 7 lakh rupees when a car is sold. Out of 7 lakhs, 6,50,000 is towards car and 50,000 is towards warranty. This warranty will get to end only in the second year. Hence, what they have stated, what they have done is, this 50,000 is set aside in the balance sheet as liability. Without recognizing it as revenue immediately, they have set it as liability for future. That is, that will be recognized as income in next year. But what income tax says, the moment you collect, you are supposed to completely recognize. So hence, under income tax, you would have taken full 7 lakhs, but under books of accounts, you have taken only 6,50,000 as revenue. So what is happening here? Under income tax, you have recognized more revenue and paid more tax. But under books of accounts, you are paying tax only for 6.5 lakhs. So for 50,000, you are not paying tax at all. You have not accounted that at all till now. It will get accounted as income only in the next periods. So automatically, you have paid more tax under income tax when compared to books of accounts. So if you have paid more tax in this period, in future you will end up paying lesser taxes. That means deferred tax asset should be created in case there are any warranties. Okay. So deferred tax asset should be 50,000 into 40%, which comes to 20,000. But deferred tax asset currently is 0. So create DTA. Entry would be DTA to P&L 20,000, 20,000. Okay. Now, in this problem, if you see, you have 2 DTLs and 1 DTA. Can I net off and show only one effect? Yes, you can. Yes, you can. So final impact would be, in the first equipment case, you have to create 32,000 of DTL, and prepaid insurance case, you have to create 30,000 of DTL. For warranty, you need to create 20,000 of DTA. So net off, if you see, 30 plus 32 minus 20. 30 plus 32 minus 20 is going to be 42,000 of DTL, which should be created finally. Okay. So you can net off and show only 42,000 of DTL in your P&L for creation of DTL. Okay. So this is what you are supposed to do for where there are multiple items in the same financial year for which deferred tax effects are to be calculated. Let's go to next question. Fourth question, please see. Sunshine Limited reported income of 90,000 before taxes for the financial year ending financial year 2015-16. Suppose the provision for income tax and deferred tax assets and compute the provision for income tax and deferred tax asset and liability. The following data is provided. Rent received is advance. Rent received in advance immediately. Taxable income from exempted government bonds 20,000. Depreciation deducted from income tax purpose is in excess of depreciation reported for accounting income 10,000. Income tax rate 35%. So various details he has given. Pani, yes, one single entry is sufficient if we pass. That's fine. generally what happens is, generally, I mean, like, in practice that is not done. I'll tell you why. In practice, they calculate deferred tax effect for each transaction. Okay, I mean, like, I'm talking about absolutely matured entities where they have proper accounting controls in place. They do it in practice. They do it independently for each item for which deferred tax is being calculated. In such case, it would be for each item, they would independently pass entries. At the end, it is grouped up and shown as one impact. It is either effect deferred tax asset or liability. That's how they group it. But in examination, if you pass one single entry for all the effects together, it's fine. Yeah. So in this question, he has given you details of some incomes and other details. So let us see how it would impact our deferred taxes. So first item, rent received in advance. Okay. So he says that from income tax perspective, rent received in advance is taxed immediately. That means where you are supposed to show it as income of next year, you have charged to, you have taxed it in tax P&L this year itself. Okay. So if it is immediately being taxed, I will end up paying more taxes in the current year. So in future, I will be paying lesser taxes. Okay. So first category, first item, deferred tax asset is created. Deferred tax asset is created. So that is equal to 16,000 into 35%, which is 5,600. Okay. Next, second item. Taxable income from exempted government bonds. So it is basically not a temporary difference. It is a permanent difference because your income from government bond may be shown as income under books of accounts. But, oh, it's a taxable income from exempted government bonds. Okay. Yeah. Yeah. Sorry, guys. There was a call, so I couldn't get back. Yeah. Let's get back to this question. So we are done with rent received in advance. Rent received in advance is over. So second point, taxable income exempted. I think there is some. Okay. There's some typo error here. Please correct it. This taxable is part of here. Taxable is part of here. It is not taxable here. Income from exempted government bonds. Please make a small change. It's a correction. Okay. So income from exempted government bonds, that means it would not have any tax effect at all. Whether you receive it now or in future, it's a permanent difference. It's a permanent difference. Hence, it will not have any impact on your deferred tax calculations. So for the second item, please mention. So number 2, exempted government bonds, no DTE. Third, with respect to depreciation, yes, there will be some impact. Let us calculate. Depreciation deducted for income tax purpose in excess of depreciation reported for accounting income. So 10,000 is additionally deducted under income tax. That means I will be paying lesser tax this period, and in future I'll be forced to pay more tax. Okay. So DTL should be created. So it's going to be 10,000 into 35%, which is 3,500 DTL. So entries, if we write independently, entries would be for DTA to P&L 5,600, then P&L to DTL, it is 3,500. Next, presentation in financials, reporting, if you see, I think he has given you details about current tax details are given, which you are supposed to calculate. I will first prepare the schedule. Profit before tax is given as 90,000. Taxation, deferred tax, current tax and deferred tax. Let us calculate. Deferred tax, it is 5,600 minus 3,500, which is positive 2,100. Positive. Okay. And current tax, let us calculate. Current tax, he has given you some information. Profit before tax is 90,000 as per books. Okay. And less income from exempted government bonds. It should be deducted, which is 20,000 should be deducted because this is not taxable under income tax. And rent received in advance is to be added because under income tax it is supposed to be charged to tax immediately, and then additional depreciation under income tax is 10,000, which we should deduct. So on deducting all this, you get a, of course, sir, that is what I did in DTE. See, finally presentation, that's what I did, no? Can we set off DTA with DTL? That's what we did. See, please see here. This 2,100 is net of DTA only. Okay. So let us finish off this current tax calculation. So I have 76,000 of profit before tax, and current tax at 35%. will be 26,600. 26,600. This is what my current tax here would be. 26,600 is current tax, and deferred tax is 2,100, which is asset, deferred tax asset. So finally, net of profit after tax would be 65,500. I hope you guys are able to follow this. Any doubts, please ask. Any doubts, please ask. Otherwise, we'll go ahead. Previous slide. Ido. Okay. So let us go ahead to next question. Fifth question, please see. Manu International Limited had pre-taxed accounting income of 5 lakhs and taxable income of 8 lakhs. For the financial year 2012-13, the only temporary difference is accrued product warranty cost, which is expected to be paid as follows: 50,000, 1,50,000 and 1 lakh from 2013-14 to 15-16. Manu International Limited has never had any net operating losses, book or tax, and does not expect any in the future. There was no temporary difference in prior years. Income tax rates are 40% for 12-13, 38% for 13-14, 35% for 14-15, 32% for 15-16. Calculate DTA or DTL for each financial year. Mark this problem important. Mark this problem important. This is a good standard problem. So let us do. What he is saying is, he wants you to calculate for each of these years what is the deferred tax impact in your financials. Okay. So right now we are in 12-13 financial year, and post which slowly they will reverse. Now what is getting reversed, please observe. He says books of accounts, it is 5 lakhs, but under tax it is 8 lakhs. The difference is 3 lakhs. The same 3 lakhs is what he has explained here again. When they get reversed is what he has explained here. Okay. So based on that reversal, you are supposed to calculate your DTA or DTL impact in your financial statements. I hope I made it clear with an explanation. Now let us start with the solution. Whenever a question of this kind is given, please do it for each year independently. Each year independently. Year 2012-13 first. Year 2012-13 first. For this, there are two rates which are given. Current tax rate is 40%. Deferred tax rate is 38%. Why is deferred tax rate different? Because for deferred tax, you are supposed to use future tax rate. Future tax rate, FTR. Okay. Future tax rate is to be used. So that is deferred tax rate only. Okay. Now these are the two pieces of information which are required for me. Current tax rate is used for current tax calculation. Future tax rate is used for deferred tax calculation. So based on that, we will accordingly use now. Now please see, when he says as per books of accounts it is 5 lakhs and as per income tax it is 8 lakhs income. What does that mean? The deduction under books of accounts route is greater than your tax route. Yes or no? Only because your deduction has been more in books of accounts route, your income has fallen down, your net profit has fallen down to 5 lakhs. So please see the deduction part we are supposed to concentrate on. So deduction under BOA till date is equal to 3 lakhs. Okay. Next, deduction under tax till date is 0. That is what he's saying. Okay. So your tax income in future will be less than your books of accounts. Okay. So what happens is, today you are paying more tax on your tax revenue. You are paying more tax on your tax revenue. Hence, your DTA should be created. DTA should be created. Should be 3 lakhs into future tax rate, that is 38%. Okay. So it is going to be 1,14,000. 1,14,000. And DTA currently is 0. That means I should fully create DTA. Okay. So entry would be DTA to P&L 1,14,000. 1,14,000. You please do along with me, guys. So DTA to P&L 1,14,000, 1,14,000. Apart from this, I'll also have to write an entry for current tax. So current tax is very simple. Current tax is 8 lakhs into 40%, which comes to 3.2 lakh. Okay. Entry for current tax would be P&L account debit to provision for tax. For tax, 3.2 lakh, 3.2 lakh. Okay. Now let us write reporting for this 2012-13. Reporting would be profit before tax is profit before tax is 5 lakhs as per books of accounts, and taxation, current tax is 3.2 lakh. Deferred tax asset is 1,14,000. Hence net would be 2,94,000. Okay. So this is your entire presentation for first year. Okay. Next, let us go to second year. So second year is basically 2013-14. 2013-14, let us do. Here again, please see what are the tax rates. Here you only have future tax rate. You don't know current tax rate at all. Okay. So let us do for 2013-14. Now, for 2013-14, BOA deduction till date is equal to 3 lakhs. Okay. Tax deduction till date is equal to, so he says in the next year how much is getting 50,000, yes or no? Reversal is 50,000. So to the extent of 50,000, we are supposed to take it here. So let us do, it is 50,000. So DTA should be 3 lakhs minus 0.5 lakh into future tax rate for this financial year. For this financial year, future tax rate is 35% given. Okay, so it should be 87,500. It should be 87,500, but DTA currently is 1,14,000. Okay, hence what I should do is I will have to write off excess DTA. I have to write off excess DTA. So entry I'm just mentioning here itself. Entry for DTA write off would be P&L account debit to DTA. The difference between these two is 26,500. Yeah, thank you. 26,500 is DTA to be reversed. I hope you are able to follow. Next. So for 2014-15, let us do now. 2014-15 DT deferred tax rate is 32%. Deferred tax rate is 32% given. Okay. So now again, as per BOA, till date deduction continues to be the same 3 lakhs. But as per tax, till date it got changed. How did it change? Because there is a reversal which has happened for 1.5 lakh. So that importance for till date is you are going to take on a cumulative basis. Okay, till date it is 2 lakhs. That means on 1 lakh you are supposed to maintain DTA. So DTA should be 1 lakh into 32%. That is equal to 32,000. DTA is, that is currently is, last year it is 87,500. So DTA to be reversed or to be written off is equal to 55,500. Yeah, 55,500 is DTA to be written off. Okay, so 55,500 is DTA to be written off. Now, what would be the entry? Again, same entry, numbers would be 55,500. That's all. Now, come to next year. Next year is what? 15-16. Okay. In 15-16, what is deferred tax rate? He did not tell you, but let us see what will be the impact here. So in 15-16, in BOA P&L, the deduction is 3 lakhs. In tax P&L also, the deduction is same 3 lakhs. That means there is no requirement of DTE, no deferred tax effect at all on this particular transaction. So what happens is, whatever DTA is there should be written off. Should be written off. Okay. So how do I write off? How do I write off? Whatever 32,000 is there, that is completely to be written off. Entry would be P&L account debit to DTA 32,000 and 32,000. Okay. So this is how you do reversal of DTA and DTL. So how do you create and reverse? Okay. So with this, let us take a small break now. Let us take a small break and catch up by 5 o'clock again. Yeah, let's start, guys. So we're done with fifth problem. We'll go to next question. Yes. So let us read sixth question, please. Rama Limited started business on 1st April 2011. The following details are available from the books of accounts and other records of Rama Limited. Profit before depreciation and taxes for 11/12 to 14/15 are given. Company purchased the following machines. Date of purchase, amounts are given. The company charges depreciation on machine at 15% per annum, whereas the rate of depreciation for tax purpose is 25% per annum. The company has no other fixed assets. The tax rates for the 5 relevant years are 50, 45, 40, 35 and 35 respectively. You are required to prepare P&L statement and show tax expense. So there is a very lengthy problem. There is a problem where you'll have to do deferred tax impact for each of the years independently for this one particular asset. So let us do that. Yeah. So please see, guys. Now, he says this asset is purchased in he says these assets are purchased in 11/12 onwards. He started buying these assets. So we are supposed to start the answers from financial year 11/12. So 2011/12, let us do it first. Okay. Now, under both the routes, that is income route, P&L route and tax route, both the places he has given you your profit before depreciation and taxes. Okay. So that would be the base for you, and accordingly we will calculate. So let us do BOA and tax independently. So he says profit before depreciation and tax is 14 lakh 45,500. In tax also it is 14,45,500. Depreciation under books of accounts, he says it is 15%. Under books of accounts, he says it is 15%, whereas under tax purpose, it is 25%. Okay. So let us use those respective rates and take here. Now, first of all, the asset purchased in 2012-13 is, sorry, 11-12 is 3,45,000 is the value of the asset which is purchased on 1/4/2011. So on that we are supposed to calculate for both these under income tax route and P&L route. So let us do that. Depreciation under normal books of accounts route would be 51,750, and under tax route it is going to be 86,250. Yeah, thank you, Shivakumar. So profit before tax is 13,93,750, and under income tax it is 13,59,250. That means under income tax you are paying lesser tax today. You are paying lesser tax today. So in future you will have to pay more tax. Okay. So there will be requirement of creating DTL. So let us calculate current tax first, then deferred tax. Current tax would be 13,59,250 into current tax rate. Current tax rate he has given it as 50%, and deferred tax would be 86,250 minus 51,750. Between these two, whatever is the difference, that into future tax rate, which is 45% is what he has stated for next year. Hence, I will take 45%. Amounts please for this. Amounts please for this. So first one I have just calculated. It is 6,79,625. And the second one is 15,525. 16,525. I hope you guys are able to follow. This is for first year. This is for first year. Okay. While calculating second year, be cautious. While calculating second year, be cautious. Let us start. So for year 2, that is 2012-13. 2012-13. Again, same way. Books of accounts route and tax route. And tax route. Under books of accounts, profit before depreciation and tax is given as 18,20,200. Same for tax also, 18,20,200. Depreciation, don't be in a hurry. For 2 machines you are supposed to calculate. Why 2 machines? Because last year you have a machine and current year also you have a machine. Okay, current year also you have a machine. So your calculations will be for 2 machines. Now calculations are, I think here he has mentioned it as taxes per annum. So it is basically WDV method. Okay, WDV method. Let us do under WDV only. So depreciation calculation for machinery 1. For machinery 1, you are supposed to calculate and tell me. And for machinery 2 also apply respective rates and tell me. For machine 2, what is the depreciation? For machine 1, what is the depreciation? For machine 1, I don't think it is 7762 guys. It would be a little huge only. First year we have charged 51,000. So second year it would be somewhere around 40,000. It should be 43,988. Yeah. So for first machine it is 43,988, and for second machine, please. For second machine, first time only you are supposed to take. So for first machine, under tax route it is 64,688 it seems. Okay, 64,688. So please deduct. These are for machine 1. For second machine, under books of accounts it is 41,250, and under tax route it is 68,750. 68,750. Thank you. Okay. So at this juncture, please tell me profit before taxes. Profit before tax. Profit before tax would be for first under books of accounts route. Profit before tax should be somewhere around 17 lakhs. Numbers, please. 17,34,962, and under income tax route it is 16,86,762. Thank you. Okay. Now with this it's not done. With this it's not done. Current tax has to be calculated. Current tax is very simple. Current tax is going to be 16,86,762 into 45%, because for second year tax rate is 45%. Hence this is the rate which you are supposed to apply. Okay, so that is 759043. Okay, 7,59,043 is the amount of current tax. Now deferred tax, be careful. Deferred tax, what should be deferred tax? Should I calculate deferred tax liability or deferred tax asset? Deferred tax liability or deferred tax asset? It is going to be deferred tax liability only. Reason you are charging more depreciation under income tax route rather than your books of accounts route. So what you should do now is add all your depreciations under income tax route in this year and previous year. In this year and previous year, and deduct depreciation as per books of accounts in this year and previous year. So it is going to be like this. Deferred tax liability calculation. Deferred tax liability should be. I am highlighting in green. Please see these numbers. Okay, minus these numbers. Okay, and last year's we are supposed to do. Last year difference between these two is how much? Last year difference between these two is how much? 34,500. Okay, 34,500. So plus 34,500. So that means 64,688 plus 68,750 minus 43,988 minus 41,250 plus 34,500. 34,500 is nothing but we are taking it on a year to date complete from the inception of this machine till date. Okay, hence all these should be considered. So it's going to be like this: 68,688 plus 68,750 minus 43,988 minus 41,250 plus 34,500. All of this into 40%. Into 40%. So it gives me how much? 40% is future tax rate. Okay. So 33080 is required, but currently 33080 is required. Current DTL is last year we have calculated only 15,525. So opening balance is only 15,525. So DTL to be created. Is equal to how much, guys? Balance 17,555. Okay, thank you. 17,555 is the amount of DTL which you should create now. Okay, so current tax is 7,59,043 and deferred tax which you create now is going to be 17,555. So this is your final impact. Okay, next let us move to next year, 13-14. Okay, so 13-14 again same style, books of accounts and tax. Again, profit before depreciation and tax, depreciation on machine 1 and machine 2. Only 2 machines. I think the third machine came only after the year. $34,500 addition. Huh? Okay, very simple, guys. We are supposed to calculate deferred tax effects in a year on a holistic basis. When I say holistic basis, from the inception of that particular asset. Okay, so what we are supposed to do in year 2 would be 64,688. Please see this spotlight. 64,668 plus 68,750. In the previous year, 86,250 is to be added and less 43,988 minus 41,250 minus 51,750. Since we have already deducted 51,750 from 86,250, I have asked you to directly add 34,500. That's all. Okay. Yeah. So in the third year, the new machine has not come yet. It has come only in the 4th year. Hence, we can directly calculate only for these 2 machines here, the depreciation. So under WDV, please calculate for machine 1, 3rd year, for machine 2, 2nd year. Please tell me numbers. Machine 1, oh, thank you, Shivkumar. Machine 1 books is 37,389 and tax is 48,515. Okay, and by the way, profit before depreciation and tax is given in the question, which is 24,56,500, and under tax also 24,50, I guess it is. Machine 2, it is 35,062 or 24,56 only. Okay, fine. 35,062 and tax it is 51,562. Okay. So now again, please calculate profit before tax. It is going to be 2,384,109 and 2,356,482. Thank you, Vasu. So with this, your profit before tax calculations are over. Now, current tax is going to be on 2,356,482 into current tax rate given is 40%. You get some number, please tell me. Deferred tax liability should be So current tax, it is, how much is current tax? Nine lakh 42. Okay, fine, fine. I did not observe that. 9 lakh 42, 593 is current tax, and deferred tax liability should be, calculation would be, deferred tax liability calculation should be, would be, again I'm highlighting with some other ink, sum up all tax sites in all the 3 years, and deduct, BOA side all deduct, BOA side all deduct, BOA side all deduct. So when you do this, you get some number, that number into 35%. What is that number which you have got? Add all tax side depreciations for 3 years less BOA side depreciations for 3 years. Vasu, it is 38614, it seems. That is final deferred tax liability. Huh? Okay, could be. So deferred tax liability should be is 38,614. So how did I get this? It's basically lakh and 10,325 into 35% given. 325 into 35%, which is given. So I get 38,614. On this, out of this, already DTL is last year. Please see, should be. Please see last year's should be. Last year's should be is here. This is last year's should be 33,080. Okay, so that becomes DTL is for this year. So it is 33,080 when you deduct it. So DTL to be created. DTL to be created is 5,534.45. Okay. So this is for third year. Now let us do for fourth year. For fourth year also, same process, please do. For 2014-15, I hope it's done. I'm moving to fourth year. In fourth year, can you please tell me numbers? Again, BOA and the tax route. Again, profit before depreciation and tax. It is given as 30,22,280. 30,22,280 less depreciation for machine 1, machine 2, machine 3. Please be cautious. For machine 1, you are supposed to calculate for fourth year. For machine 2, third year. And machine 3, only first year. Thank you, Shiva. 31,781 and 36,387. And for machine 2, 29,803 and 38,672. Machine 3, for the first year we are supposed to calculate. It's going to be 54,300 and 90,500. So at this juncture, my profit before tax would be something. So please calculate. Okay, so it is, which one should I take for what? All right. So 29,06,396 is for books of accounts. For tax, it is 28,56,721. So current tax would be 28,56,721 into current tax rate. Current tax rate for 1415 is 35%. So that's going to be how much? 9,99,852. And DTL should be, please tell me, calculate and tell me. DTL value calculate. Again, total depreciations from tax side, all the 4 years, deduct depreciations on books of account side, all the 4 years. Why do we do it? Because deferred tax effects are to be calculated on a holistic basis. When I say holistic, from the inception till date, I'm sure you would have experienced in practice also and in your articleship. So there's the same thing what we're adopting here. So deferred tax liability should be, can someone tell me? So what's deferred tax should be? Okay. All right, 56,000. I'll take it as round off. And 56,000 is deferred tax should be, but you already have a deferred tax of 38,614. So DTL to be created is 17,384. Okay, so this is how we solve when we have it for multiple periods. With this, we are almost done with deferred taxes. Let's go ahead with next parts. Okay. All right. So let's go ahead with the next concept, which is MAT. Yeah. Please see, guys. MAT is a tax collection center for central government, where they collect a minimum amount of tax from companies who do not have a requirement to pay. That is, when there are alternative ways in sourcing out taxes from companies who are not required to pay under normal route. Okay, so there is something called book profit route, under which MAT is generally paid. Now, when we bring MAT into accounting, fairly speaking, MAT is purely connected with current tax. MAT is purely connected with current tax. It has no connection with deferred tax at all. It has no connection with deferred tax. So normally MAT, whatever is paid, has got no implications on deferred tax at all. Deferred tax calculations are purely for future what we are supposed to pay, and it has nothing to do with MAT whatever we pay in this year. And second important thing, in general, when current tax is paid, such current tax is a expense for the company, is an expense for the company. But when MAT is paid, it comes as an asset for the company. It comes as a credit or an asset for the company, which can be used over next few X number of years, during which the company makes profits. Now, considering this scenario, your accounting for MAT has got nothing to do with deferred taxation at all. MAT accounting is purely like a asset creation. You would not charge it off to P&L. But when it comes to deferred tax is a entry which we pass stating that we may have to incur so and so amount of liability in future, or we may have a asset in right now which will get reversed in future. So this is how we calculate and show it in our books of accounts. Now, the questions point of view, the question is fairly simple when to answer when MAT is questioned. So let us see the questions. 7th question, please see. From the following details of Cigar and Tobacco Limited for the year ended 31st March 2015, calculate deferred tax asset or liability as per AS 22. State your views about the tax rate to be used. If the timing differences would reverse in a period in which they would still be paying tax under MAT under section 115 JB. Okay, so accounting profit is 5 lakhs, book profit as per MAT 4,50,000, profit as per income tax 50,000, tax rate 30%, MAT rate 7.5%. So these are the details which he has given, using which he is asking us to account for. So let us do that. Now, first of all, we will calculate current tax keeping MAT aside. Let us first calculate current tax and see how much would be the current tax. Okay, so current tax is calculated on normal profits under income tax route. Okay, so current tax is equal to, he says, as per income tax the profit is 50,000 into 30% is the normal your, what is the amount of tax rate? Yeah, 30%. 30% is the normal tax rate. Okay, so it becomes 15,000. However, under MAT route, if you see, he says the profit is 4,50,000 and tax rate is 7.5%. Tax rate is MAT rate is given as 7.5%. Instead, to be more realistic, make it as 18.5%. Let it be more realistic. That is the real rate what we have now, more or less the same. Okay, so at 18.5%, let us take it. Okay, so at 18.5%, can you please tell me the numbers? 4,50,000 into 18.5%. So it is going to be 80 something. 83,250. Yeah. Okay. Thank you. 83,250. 83,250 would be under MAT. Now, out of these two, which one would I consider for taxation, current tax? Out of these two, I would consider whichever is higher. Okay. So current tax which will be considered is 83,250 only. This is under regular tax route, and this is under MAT route. Okay. So 83,250 is what I pay under normal tax route. Keep this aside. That's all. Now, how much would I account for DTL, DTA or DTL? First of all, DTE. If you see, deferred tax effect is to be calculated based on future profits or future transactions which get reversed. Now, under normal under normal books of accounts route, it is given as 5 lakhs. Under regular tax route, it is given as 50,000. That means there is a difference between these two to a tune of 4,50,000. On this 4,50,000, we are supposed to calculate deferred tax. Now, today I am paying tax considering this 50,000 only. That means in future I'll have more income. That means in future I'll have to pay more tax. That is, we'll have to create deferred tax liability today. Okay. So deferred tax liability is to be calculated on the difference between these two. It is going to be 4,50,000 into 30%, which comes to 1,35,000. 1,35,000. Okay. So this is what we write as an entry. We write as deferred tax liability. Now, next question what comes is how accounting should be done for MAT. Whenever MAT is paid, the amount which is paid in excess of normal, normal tax route will be created as an asset. So what happens is, I will show you here. I have actually paid 83,250. Out of this, had I normally moved through my books of account route, I would have paid 15,000 tax. Additionally, how much did I pay? 68,250 is my additional payment of tax. This is what I call as MAT credit entitlement. This is what I call as MAT credit entitlement. Please listen once again. Normally under tax route, if I pay, I would have just paid 15,000. But because I am forced to pay under MAT route, I have paid 83,250. So since you have paid more than your capacity, what department says is any amount which you pay over and above your regular route, over and above your regular route, we will give you a credit. We will give you a MAT credit, which you can show as an asset in your balance sheet. In future, in which year your profits are more than MAT route, in that financial year, you can utilize that to extent of 10%. So that is what that is what income tax rules are in our country. Okay. So hence the 68,280 should be shown as a MAT credit entitlement. Now, how will accounting happen? Accounting will be like this. Normally, when I pay tax, P&L account debit to provision for tax, full amount please take 83,250, 83,250. Keep that aside. Now, out of this 83,250, 68,250 should go to asset. Hence, what we will do is we will create a MAT credit entitlement account and transfer that 68,250 to this from P&L account. So this is accounting how it happens in for MAT. Okay. Now presentation wise, if you see, presentation wise in P&L account, this is how it is going to be presented. Profit before tax is in the books of accounts. Accounting profit is 5 lakhs. That is the profit which we will be showing. Profit before tax is 5 lakhs. Then current tax is taken for the entire amount, 83,250. And then deferred tax liability will be taken for 1,35,000. And then MAT credit will be a positive figure for 68,250. So net off will be shown as your profit after tax. This is your presentation in your P&L. So could you please tell me the amount? $350,000. Fine. Okay. Any doubts? Please ask, guys. Any doubts? Deferred tax part alone, please repeat in this problem. I'll unmute you. Wait. Kritika. Hello?
The deferred tax part of 1,35,000.
All right, I'll explain that.
The deferred tax part of 1,35,000.
Yeah, fine. Now, see, deferred tax part here, don't bother about your MAT calculation at all, first of all. Just like how you normally calculate your deferred tax, even in MAT environment, you are supposed to do the same thing. Generally, what do you do for MAT calculation? You will go you will go with the difference between books of accounts profit and tax profit. That's all, right or not? The same is adopted here again. 5 lakhs is my books of accounts profit. 50,000 is my tax profit. The difference between these two is 4.5 lakhs. On this, I have taken 30%, which is 1,35,000. That's all. Just because the MAT has come doesn't mean your accounting will completely differ. No. I hope this will be clarified. Presentation, huh? No big difficulty here. See, first step what you did is regular route tax calculation. Okay. Then MAT calculation is done. You can put it as bullet points and solve. That's all. There is no specific template for these problems. In fact, most of the accounting standard questions, it goes in the flow. Okay. Unless it is consolidation, amalgamation, or some other problem, we will give you a sequence of events how we can solve it. But in this, I don't really foresee any sequencing. So what you're supposed to do is calculate current tax under regular tax route. You get some number. Under MAT route, calculate what is the amount of tax supposed to be paid, and then calculate deferred tax. Deferred tax calculation would be take books of accounts profit and take tax profit. Compare this to whatever is higher. I mean, like for the difference of these two, create DTL. Create DTL because you're paying lesser tax today. You're paying lesser tax today. Create DTL, and then you give a breakup of your entries. For your entries, you are supposed to give breakup. So those entries are given here. That's all. Paniram, I hope this is sufficient. All right. Let's go ahead to next question. Yeah. Tax holiday. Before tax holiday, let us first finish off carry forwards. Then we will come to tax holidays. You want the screen? 1 second, please take. All right. Yeah. So next question, let us go. Set off and carry forward of losses. Now, let's read the question and then discuss about it. PQR Limited's accounting year ends on 31st March 2014. The company made a loss of 2 lakhs for the year ended 31st March 2014. For the year 15 and 2016, it made profits of 1 lakh and 1.2 lakh respectively. It is assumed that the loss of a year can be carried forward under under tax laws, and the tax rate is 40%. By the end of 31st March 2014, company feels that there will be sufficient taxable income in future years against which carry forward loss can be set off. There is no difference between taxable income and accounting income, except that the carry forward loss is allowed in the years ending 2015 and 16 for tax purpose. Prepare a statement of reporting P&L for the year 2014, 15 and 16. Now, whenever a question talks about how, whenever a question says there are, carry forward, set off and carry forward of losses from previous years, you are supposed to create DTA or DTL only if there is possibility of reversal. That means in future, if you feel you will be attracting DTL, only then create DTL. Otherwise, there is no requirement of creating DTL. So these are few things which are supposed to be kept in mind while doing. So for 2014, let us do, for each of the years he has asked us to do, let us do it. Okay. So in 2014, books of accounts P&L and tax P&L, let us do separately. Now, he says in the books of accounts P&L, you have got a loss for 2 years, loss of 2 lakhs for the year 31st March 2014. Okay. Say, let us come up with a illustrative example here. Illustrative example here. Say, I made a revenue of 3 lakhs. Okay. And I ended up with an expense of 5 lakhs, which means I have a 2 lakhs of loss. Right. Same thing. Under tax laws, what is he saying? Under tax laws, what he says is, you don't have that. Okay. Under tax laws, he says your income is 3 lakhs and expense is also 3 lakhs only. Hence, there is no impact of loss in your tax P&L. Okay. Now, what should I be doing? So, I am ending up with no loss under tax route. I'm ending up with no loss under tax route. So my presentation, how it happens is, profit before tax would be 2 lakhs. Is there any current tax? Current tax is nil. But for deferred tax purpose, deferred tax asset can be created by me. Deferred tax asset can be created because I am considering lesser expense in this financial year under tax route. Instead of considering 5 lakhs, I am considering only 3 lakhs. Okay, I did not consider 5 lakhs, but I considered only 3 lakhs. That means in future, I will be paying lesser taxes, yes or no? Though you did not pay any tax now, in future you will be paying lesser taxes because of lesser consideration of expense in this financial year. Right? Hence, a DTA should be created to the extent of 40% on 2 lakhs. So it's going to be 0.8 lakh, which is 2 lakhs into 40%. I'll repeat once again, guys. Please see. I have come up with the illustrative numbers here. He has only told me that 2 lakhs is the loss as per books of accounts, but that loss does not exist under tax route is what he says. That's all. In such scenario, just come up with a rough example. Say I had a revenue of 3 lakhs and my expenses in the current year are 5 lakhs. So my loss in books of accounts is 2 lakhs. However, under tax route, I have 3 lakhs of revenue, same 3 lakhs, but expense under tax loss has come up only to 3 lakhs because he did not allow me to take the balance 2 lakhs of expenses. So automatically there is no profit, no loss, and I have ended up paying no taxes in the current period. However, though I don't pay any taxes in the current period, I will have a future saving of taxes due to the 2 lakhs which is not considered as expense under income tax in this year. Hence, I can take deferred tax asset to the extent of 40% of 2 lakhs, which is not considered as an expense under income tax. So that is what I have done here. So profit after tax would be, so here it is negative. Okay. And profit after tax would be 1.2 lakh negative. Okay. I hope I made it clear. Next year, please see 2015. In 2015, what happened? So I am supposed to see, is there any reversal? So please see the question. It made profit of 1 lakh and 1.2 lakhs respectively. Okay. So that means in 2015, I've got a profit of 1 lakh. So my, cumulative impact would become only 1 lakh. Okay. So I'll have to rework on my deferred tax asset. In 2015, under books of accounts, I have 1 lakh of profit. Okay. Under P&L also, under income tax also, say I have got 1 lakh of profit only. Though I have got 1 lakh profit, from last year's 2 lakh, 1 lakh I will utilize now, no? Okay. So since he has stated that unabsorbed loss of last year is there, I will utilize that 1 lakh in this year and reduce my tax expense. Okay. So now effectively, if you see, my profit before tax is 1 lakh, current tax is 0 because my profit is offset against unabsorbed loss of last year. Okay. And deferred tax asset should be 1 lakh into 40%, which is 40,000. But I have a deferred tax of 80,000. So what I will do is, that is deferred tax of last year, what I created, 80,000. Okay. Now what I'll do is, I'll reverse to the extent of 40,000 so that it becomes only 40,000 now. So deferred tax asset reversal will be 0.4 negative. So it's going to be 0.6 profit after tax for second year. I hope I'm making sense. Any doubts, please ask. If you want, I don't mind explaining once again. All right. So let's go to next year. In year 2016, what did he tell you? In year 2016, your income, your income in normal route is 1.2 and tax is also 1.2. That means as per BOA, you have 1.2 lakh. As per tax also, you have got 1.2 lakh. However, you still have that credit of 1 lakh of unabsorbed loss of 2014. So you will use that 1 lakh here. Automatically what happens is your profit before tax is 1.2 lakh. Current tax will be 20,000 into 40%. 20,000 into 40%, which has come to 0.08 lakh. And deferred tax asset, whatever is created, can be written off completely now, because your entire revenue has been recognized in both the places. Okay, your entire expense has been considered in both the places. Hence, you will reverse off the 40,000, whatever you have created, whatever is balance left over also. So effectively, it's going to be 0.48, and your profit after tax would be 0.72. Okay, so this is how you account in your books of accounts for whenever there are losses and carry forward of losses. Any doubts, please ask. All right. DTA part once again. Huh? Okay, fine. I don't mind. Please see. First year, I have come up with the illustrative numbers. The numbers are, say I have made 3 lakhs of revenue, 5 lakhs of actual expense, and I ended up with 2 lakhs of loss. However, yeah, under income tax, if you see, revenue is taken as it is, but expenses are considered only up to 3 lakhs, though I actually have 5 lakhs. Okay, so that is the first issue which has happened. Now, because he has considered only 3 lakhs, I have a 2 lakhs of excess unabsorbed loss in this financial year, that is in 2014. Okay, now the 2 lakhs I will use in next future periods. First of all, let us finish off this financial year. In this financial year, my profit before tax is 2 lakhs as per books of accounts. That is the same 2 lakhs. Is there any current tax I am paying? No current tax is required to be paid, because under income tax, exactly 3 lakhs is considered as expense. Now, coming to DTA to be created. Why should I create DTA? Because right now I have 2 lakhs of unabsorbed loss which I can use in future years. That means I need not pay tax in future to the extent of 2 lakhs. Hence, I am creating a DTA today. How much did I create? 0.8 lakh is what I have created. So finally, your profit after tax, which is shown in the balance sheet, is 1.2. Okay. So this is for the first year. Coming to second year, I made a profit of 1 lakh. The same profit of 1 lakh is taken in income tax also. But the fact is, against that 1 lakh, I will set off, out of the last year's 2 lakhs, I will set off 1 lakh here. Okay. So when I set off 1 lakh, I will have 1 more lakh of unabsorbed depreciation. So for that, this calculation is done here. I am supposed to maintain 40,000 of deferred tax asset. Okay, because of that 1 lakh of loss which is still pending with me. But right now I already have 80,000 of deferred tax asset. So what now I will do is, I will reverse to the extent of 40,000 for the amount what is already consumed now. Okay. So automatically my profit after tax will be 0.6 lakhs. Now coming to third year, I have got a profit of 1.2 lakh. Same profit is taken in income tax also. However, out of the 2 lakhs, 1 lakh is consumed in 2015. The balance 1 lakh is what I'm consuming in 2016 now. So I have consumed 1 lakh here also in 2016. 1 lakh is taken. Automatically, my profit in 2016 will be 20,000 under income tax. On the 20,000, I have paid current tax, which is 40%, 0.08 thousand or 0.08 lakh. And deferred tax already is created. Already created in 2014 is 80,000, of which 40 is reversed in 2015. And the balance 40, there is no requirement to maintain because entire revenue has been considered. Entire expense has been absorbed now. So there is no point maintaining the DTA. Hence, the balance 40, whatever is left over also, I am charging off, I am writing off in the P&L now. Okay. So this is what we have done. All right, let's move to the last leg in the standard regarding what do you call tax holidays. Yeah. Whenever there are tax holidays, you are supposed to create or defer. You are supposed to create or write off only when there is when it happens after your tax holiday period. So that's the important crux here. We will see the problem and then discuss further. Okay. Yeah, please see 8th question, tax holiday question. Income before depreciation and tax of an enterprise is 200 lakhs per annum. It is eligible for 100% tax holiday for the first 10 years under 80 IA of Income Tax Act. Tax rate is 35%. At the beginning of year 1, the enterprise purchased a machine costing 300 lakhs. The enterprise follows SLM depreciation method for accounting purpose. Scrap value is nil and useful life is 15 years. For the purpose of taxation, it has to follow WDV method of depreciation, applying 25% tax rate. Show AS22 effects. Now, I'll solve this problem in an Excel sheet. You please see. This goes in multiple rows. So please take columns like this: year, books of accounts, depreciation, tax depreciation, cumulative BOA dip, and cumulative tax depreciation, difference, DTL should be DTL is current year effect. So he has stated that this machinery is useful for 15 years. So I'm taking count of 15 years. Okay. So under books of accounts, he says it is depreciated flat. It is depreciated flat over 15 years. So it's going to be 300 divided by 15, which comes 20. So it's the same 20 for all the years. But when it comes to taxation, it is not like that. Tax depreciation, let us do it like this. 300 is equal to this into 25% is equal to this minus this. Okay. So it's going to be 56. So over years, this is how it goes. Okay. So we only need tax depreciation values. We don't need book values at all. Okay. So these are only for our calculation purpose I have taken. Now cumulative books of accounts depreciation is this is equal to this plus this, like that it goes till end. Same way tax depreciation is equal to this is equal to this plus this. Cumulative depreciation okay. Now so difference, if you see this minus this, okay. So DTL should be would be on this difference. We are supposed to calculate DTL. Okay. So DTL should be is difference into future tax rate. Here future tax rate, did he tell you anything? He has told you that future tax rate is 35%. That's all. He did not tell you about current, future and all. Let us assume that is only future tax rate. So it is going to be this into 35%. So 19.25, like that, apply on everything. Okay. So take it for up to 2 decimals. Okay. So DTL should be, you may get a negative value at the bottom. Let that be there. I'll tell you what it is. Okay. You may get a negative value at the bottom. Let it be there. I'll tell you what it is. Now, DTL is, so initially DTL is 0. Okay. So if it is 0, this year, what should I do? I should create DTL. Okay. Create DTL. So how much should I create? It's going to be full. Okay. So second year opening balance is 19.25. Right. Second year opening balance is 19.25. So I need to create. Okay. So how much should I create? This minus this. So I will pull it down for all and then tell you what has to be done. So create happens till fifth year. Till fifth year creation happens because you do not have it there. Okay. So from 6th year to 10th year, you are on a what do you call this? Tax holiday period. You are in a tax holiday period. To the extent of this tax holiday period, you are not supposed to reverse it. Okay. To the extent of tax holiday period, you are not supposed to reverse it. Sorry, you are not supposed to, write off. Write off is not allowed. Okay. But from 11th year onwards, again, you can write off. I'll explain this completely to you. Let me first finish it off, then I'll tell you. Okay. Now, so please see the explanation now. I hope you guys are listening. This problem he has mentioned stating there is a entity which is in tax holiday period. There's about an entity which is in tax holiday period. So income before depreciation and tax of an enterprise is 200 lakhs. It is eligible for 100% tax holiday for the first 10 years under ATIA. Tax rate is 35%. At the beginning of year one, the enterprise purchased a machine costing 300 lakhs. So that means this enterprise machine, whatever is purchased, is supposed to be written off over 15 years for that life. Okay. Scrap value is nil, useful life is 15 years. So considering these parameters, he is asking us how accounting should happen for deferred tax. Now, are you guys able to see the screen? All right, yeah. So what I did is I have taken all the years from 1 to 15. Books of account depreciation is taken for all the 15 years independently. Tax depreciation is also taken for 15 years independently. Then I have taken cumulative books of accounts depreciation. And then I have taken cumulative tax depreciation. Why did we take this? Because we calculate deferred tax effects on cumulative basis, but not on individual year basis. Okay. Difference between these two will tell me how much of, on what value I should create deferred tax asset or liability. Okay. In this case, what happened is your difference is positive. How did I get difference? Cumulative tax depreciation minus cumulative books of accounts depreciation. If it is positive, it indicates that tax depreciation is charged more, which means I will be paying lesser taxes today, which will eventually impact me to pay more taxes in future. Okay. So this is first important part. And deferred tax liability to be created is 55 into 35%. 35% is the tax rate which he has given. Hence, that is the rate which we have applied for the entire year. Okay. And current DTL is 0. So for the first year, it is 0. For second year, I would have created for the first year. Hence, it's 19.25. Like that, it keeps going. Okay. Now, what is important for us in this question is, during tax holiday period, there will be few tax expenses which will get reversed within the tax holiday period. Okay. So for the amounts which get reversed within the tax holiday period, you need not provide deferred tax liability at all. That is what standard says. Now, if I create 19 in the first year, 19.25 in the first year, out of that 19, please see this yellow highlighted, 16 will get reversed within the tax holiday period. That means out of this first year's 19.25, 16 is getting reversed in the within the tax holiday period. Hence, what standard suggests is, in the first year when you create, instead of creating for 19.25, create only for the balance amount. That is balance in sense 3.25 only should be created. Okay. And remaining rest of calculation, go ahead as per your existing schedule. Okay. So this is what standard suggests you to do while solving a problem which has got tax holiday periods. This is the only part which is important. I don't think examination such questions would be tested, but still from conceptual understanding you need to know. Okay. So this is how we do. Now entries wise, you are supposed to understand how entries would be passed. Entries would be, for first 5 years, you are only creating DTL. So entry would be P&L account debit. P&L account debit to DTL, which would be, as I have stated initially, 19.5 should be created, but still since since to the extent of 16 it's getting reversed within this tax holiday period, I will not create that at all. I will not create to that extent at all. 3.25 is what I take, and this is going to be negative 3.25. Okay. Okay. So this is for first year. So for second year, it's going to be for second year, I would take it as it is, whatever is calculated. Okay. Third year, 7.7. Third year, it's going to be, I will be creating 7.7. Fourth year, I will be creating 4.07. Fifth year, I will be creating for 1.31. Okay. Now, from 6th year to 10th year, I need not pass any entry also, because I know that it's getting reversed. Okay. So I need not pass entry because I have not created at all first. In the first inside, I did not even create. Hence, I will not pass any entry from 5th year to 10th year. So 5th year, 6th year to 10th year, for all this, no entry. Okay. Again, from 11th year onwards, I'll have to do. From 11th year onwards, we will have to write entry. Please be careful here. So from 11th year, I'll have to write off the DTL created, because it is getting reversed now. It is getting reversed now. Hence, I'll have to reverse the DTL. So DTL account debit to P&L. Okay. How much will I reverse? Same way. This value. Okay. So to this extent, I'll reverse. So in 12th year, I'll reverse 5.89. Okay. In 13th year, I will reverse 6.17. In 14th year, I'll reverse 6.38. Okay. Now, please see here, 15th year is tricky. If you see from whatever you have created, please see till here. I hope you are able to see the sum option at the bottom. At the bottom, I am highlighting here. Please see here. My cursor is there. Sum option, are you guys able to see? Yes or no? All right. So when I take a sum of all these till 14th year, I have written off up to all the numbers except 5.13. But 15th year, if I take 6.54, I am actually going negative 1.4, which means I will have to create a deferred tax asset rather than charging off, because whatever I have created is only 45.08. My deferred tax liability created is only 45.08, which I have been slowly writing off till here, till 14th year. In the 15th year, all I can write off is 5.13, and in the 15th year, I'll have to additionally create 1.4 to the extent of deferred tax asset. Or the same thing you can observe here also. In the 14th year, deferred tax liability should be 5.13 only. Okay. So that deferred tax liability only should be written off in 15th year. In 15th year, it has come out stating I should have a deferred tax asset of 1.4. Okay. So for that, entries have to be passed accordingly. So please see, deferred tax liability account would be debited with this, and one more entry will be written to create deferred tax asset. Not in all these years, only in the 5th year, we will write this entry. So these are the entries which we will pass for all these years. I hope you guys are able to follow. If you have any doubts, please ask me. I'll be happy to help. Any doubts, please feel free to ask. DTA part once again. All right, no problem. Yeah. DTL, if you see, we have created 45.08 and written off till 14th year, whatever is possible. And in 15th year, I am left with only 5.13 to be written off. That is what this sum indicates. Out of whatever is created till 14th year, I have written off something, and left over to be written off is only 5.13. Hence, to the extent of 5.13, I have passed a right of entry. I have passed a right of entry here for 15th year. And additionally, if you see in deferred tax, DTL should be, it is stated as negative here. It is stated as negative here in 15th year. The moment it is shown negative, it indicates it is not DTL, it is DTA to be, should be. Okay. So hence what I have now done is, in the 15th year, I have created DTA to the extent of 1.4 by using P&L account. Okay. So this is with respect to DTA and DTL creation, right of everything under AS. I hope you guys understood. Any doubts, please feel free to ask. Otherwise, we will move to next topic. We are very much in schedule. Don't worry. Maximum maybe by 30th, I'll try finishing off. If not, we will cover up in one more day. I just wanted to give you an update on this also. Any doubts, guys? Others? All right. So problems like this tested in exams. Actually, I mean, like this problem is also there in your institute study material. So I don't want to take risk of missing out explaining this. Hence, I have explained. I think very long back, once this was asked, very long back, maybe around 8 years or 9 years, I guess, when I passed, long back. Even before I passed, I saw during my practice manual days. So, okay. Anurag, 3.25, because as I was mentioning, you are actually supposed to create 19.25. However, out of that 19.25, during this, what do you call this period? Set off period itself, that is your tax holiday period itself, 16 is getting reversed. So when it is getting reversed within the tax holiday period, there is no real impact in your books of accounts by creating and then writing it off. Hence, what we did is, we have directly created only 3.25 once for all. Okay. And the same has been written off over, rest of the period. That's all. Okay. All right. So let's go ahead with one more topic. I'll finish off segment reporting theory. One problem I have given, but still I believe you guys don't need any support with respect to segment reporting. That's such a simple standard. I'll quickly explain the theory part and what differences exist between AS and Ind AS, and then take a leave for today. Tomorrow we will pick up a few more standards and close, so that from day after tomorrow's we can start with consolidation. Now, one and a half day, sir. 1.5 days for consolidation. I missed out to mention about valuation standards, valuation in that, but we will do it for a day. All right. So let's go ahead with segment reporting, another simple standard. Yeah. Segment reporting, AS 17 and Ind AS 108. Ind AS 108. Now, take example of companies like Reliance or Tata. They would have multiple lines of business. Say Tata has got within it multiple lines of business. I'm only talking about Tata Motors. Under Tata Motors, there are multiple subdivisions, like there are luxury cars like Jaguar, and then there are daily usage cars, normal, like economy class cars, and there are travel vehicles, there are buses also in it, there are lorries, and recently they have come up with electric vehicles also. Electric vehicles, which is one of the new product which Tata has come up with. Now, Tata Motors, while presenting its financial statements, if it simply presents profit and loss account and balance sheet, the readers of financial statements might not be happy, because they would like to know in deep in each of these lines of business, how much business has happened, what is the profit made by each of these segments, what is the loss incurred in either of these segments, what are the value of assets indebted in this particular lines of business. So like this, there will be list of questions for the stakeholders. So to ensure a very fair reporting format, segment reporting has come, which will remove all the hues with respect to how what is the revenue, what is the cost incurred. So basic details with respect to each segment is disclosed through a specific report, and that report is what we call as segment reporting. Now, from standard perspective, standard does not tell you how who should adopt segment reporting, but standard only tells you how segment reporting should be done. Secondly, segment reporting right now in India is mandatory for all listed companies. Other companies, it's up to them to prepare if they would like to. If their stakeholders are interested, yes, you'll have to prepare segment report. Otherwise, not really required. Now, having this in mind, let us now understand what segment reporting is and what sort of segments can be drawn. Under AS 17, segments can be broadly classified into two. One is called as a primary segment, second a secondary segment. Apart from this, you can also differentiate your segments based on geographical location, geographical presence. That means Tata can state its primary segments as luxury cars, then buses, then tractors, like that, so on and so forth. And secondary segment, they can state that nano car is a specific car which is targeting only low and middle income groups, or they can state that secondary segment could be manufacture of spares and parts for cars, spares and spare parts for cars. So in such case, these would become secondary segments, and all those cars, buses, trucks, lorries, everything will become primary segments. This is one way of categorizing your segments. But there is one more way of categorizing, which is based on geographical presence. That means in India, all my operations put together is XYZ. I also have presence in US. In US, my my presence value is so much. Like this, also you can split and show based on geographical locations. So segment reporting can be done either primary, secondary, or based on geographical. It's up to the management to choose. It's up to the management to choose which way they would like to do. But predominantly, most of the companies adopt primary, secondary. They only give geographical location information as a secondary information only. Secondary information only. Now, having said this, how do I identify segments? How do I identify segments? AS 17, identifies segments on a very simple note. That is, where did this go? Yeah. Yeah. So AS 17 tells that segment is to be identified. Segments are to be identified based on the type of assets, type of products which are being manufactured. That is, for example, say under cars, I have luxury cars, I have economy cars. Under economy cars, I have normal, and I also have nano. Say Tata would like to identify normal cars as one segment and nano cars as one segment. Yes, you can do. Okay. It all depends on the kind of facilities which are being used by this particular cars manufacturing facility. That means in a particular facility, if I am manufacturing normal cars and nano cars together, I can club them all and state that it is one category. Or if the resources being used by various categories are the same, and the place where they are being sold is the same, I can recognize all the segments as one category of segment. But this is how it is going to be recognized with respect to segments. Now, how do we, after identifying X number of segments, should I prepare a report using all the segments is another question. Standard says you did not report all the segments. Instead, there is a 5 checkpoint. If one of these gets triggered, you are supposed to report that particular segment. So what are these 5 checkpoints? The first 3 are called as 10% tests. The fourth is called as management choice, and fifth is called as 75% test. Now, what are these first 3 10% tests? 10% tests basically are 10% of segment revenue test. Second, segment result test. Segment result test. Third is segment assets test. Now, what is this? Segment revenue means out of the total revenue of the organization, if the segment revenue is more than 10% of the total revenue, both including an internal and external together, then that segment has to be reported. For example, I have 1,000 crores of turnover in my company. Out of this, normal economy cars make 105 crores turnover. So 105 crores has crossed 10% of 1,000. Hence, I will have to recognize that as a reportable segment. Next, segment result. Now here, segment result means profit or loss of that particular segment. And when I check for segment result on a 10% test, it should be checked on a a pure number basis, but not based on your whether it is profit or loss. So that means it is supposed to be tested for absolute numbers. Now, what does that absolute number mean? For example, out of this 1000 crores, I made 100 crores of profit. Now, if I have a segment which has got 10 crores or more, either profit or loss, either of this, if a segment has got, such segment becomes reportable. So say segment A has got 10 crores of profit, segment B has got 15 crores of loss, both become reportable. Segment C has got 7 crores of profit, need not be reported. Segment D has got 8 crores of loss, need not be reported. But when I say absolute numbers, my intention in conveying is you should not look at the plus or minus symbol before the number. Okay, out of the total result, check for whether there is 10% of profit or loss in that particular segment. Then you call it as 10% test. Third test is segment assets test. That means out of the total assets of the entity, if this segment's assets are more than 10%, then this segment becomes reportable. Okay. And fourth, management choice is also called as an incidental segment. That means last year, one of the segments became reportable under the first 3 tests. Hence, I have added it to my report. This year, it is not satisfying any of those 3 tests. Should I show it or not? Management will take a call. If it would like to show, it will show. Otherwise, it will ignore. Otherwise, for example, say in the beginning days, right now for electric car, the revenue, your profit or assets for an electric car of Tata might not be reaching 10%, but still Tata believes that showcasing this information to stakeholders is important to take decisions by them, and hence they would like to disclose this information as part of segment report. In such case, management can add such electric car details, electric car segment information in the segment report. Okay. Lastly, 75% test. This is where on doing all these tests, all these 4 tests, if the sum of the external revenue of all these reportable segments is less than or equal, less than 75%, you should bring in such segment, you should bring in such number of segments such that at least 75% is achieved. At least 75% of external revenue is reported. Okay. So what is important here is external revenue. In the first segment, for the first revenue test, external is not important. All internal and external together is tested in first test. But in the last test, it's purely external. Okay. So that's the information about last test to be conducted. Now, on conducting all these tests, whatever tests get qualified, those tests will be reported. How do I prepare the report now? Now, having identified, repeat 75% test. I'll repeat, sir. Now, in the first 4 tests, say I have 10 segments, out of the 10 segments, ABCD 4 segments only became reportable. ABCD only 4 segments became reportable. That means only 4 segments have satisfied 10% criteria, or management choice believes E also can be added. That's all. Now, on adding the external revenue of all these 5 segments, on adding external revenue of all these 5 segments, it has come only to 60% of external revenue, total external revenue. In which case, management should add one or more number of such segments such that this external revenue being reported in the segment report will be at least 75% of all these segments. Say for example, if I add segment F has got 10% of external revenue of the total revenue. Even if I add F, it is not sufficient because the total revenue, the total external revenue being disclosed is hardly 70% only. So it's not correct. And then we will add one more segment. Then go for G. Say G has got 20% revenue, external revenue. In such case, add G. Add G. So on adding G, your revenue has become 90%. Then automatically your reporting requirement got satisfied. Okay. So this is how you test for your 75%. Okay. Now, once we are done with all these tests, how do we prepare the report? Report preparation is fairly simple. It has got particulars and based on number of segments which are reportable, so many columns with a reconciliation column, and a total column. Okay. So for all of these, you are supposed to mention segment revenue, external, internal, then segment expense. No need to give breakup, should not give also. This is only to understand how much of expense you are incurring. Why this is very important is your expenses details are very critical. If this goes to an external party who is a competitor to you, maybe he can utilize that and start his own business there. Okay. So segment expenses need not be given of any breakup. You can simply state segment expense total. That's all. And then segment result. That means profit after tax. Or nowadays what companies are doing is they are directly giving you breakup from profit before tax. Okay. Then segment assets. Then segment liabilities, if any. And any other financial information which you would like to disclose through this particular segment reporting. Say for example, you would like to additionally disclose stating that in India my sale is so much, abroad my sale is so much, or some other classifications you would like to give more details about your segment reporting. You can keep adding the information as long as management has no objection in adding additional info, secondary information. You can add, but primarily this information is required. So this is how we prepare a segment report. Now, having said this, I think you will be able to solve the problems on your own in this particular topic. Now, I'll move to comparison with Ind AS, very important. Now, with respect to Ind AS, there are 2-3 differences here. First is called as aggregation criteria. Second, your categorizations of segments. And identifying segments. Now, what is aggregation criteria? Before we go there, I would tell you how segments are supposed to be identified. Then we will come to other aspects. Now, in a company, segments are identified under AS based on their nature or the place of business or based on the environment in which the business is operating and all. But under Ind AS, it says identification of segments is based on chief operating decision maker of that particular segment. Now, who is this CODM? This chief operating decision maker is the one who takes all the critical decisions and provides resources and all the capabilities to that particular segments within his control. So say for example, under this particular CODM, he has got normal cars, that is economy cars. He has got electric cars division. He has got nano cars division. He has got public transport vehicles also under his division. If these categories are under his control, in such case, all these will be considered as only one segment. So you would not go based on where the business is, based on the kind of product or who would be using the product. It is completely dependent on who is controlling this particular segment, who is controlling the activities of that particular segment. So all these categories will be considered as only one segment if for all these, if there is only one CODM, okay, chief operating decision maker he is called as. Now, once a chief operating decision maker is identified, any number of product lines under him are considered as one segment. So this is how we identify a segment. Having understood this under Ind AS, let us go to what is aggregation criteria and what is categorization of segment. Now, categorization of segment under AS, we have just mentioned that there will be something called primary, secondary, then you have got geographical and all. There are no such categorizations under Ind AS. Everything is primary only. Everything is primary only, and it all depends on CODM to decide whether these segments are reportable or not. That's all. Okay. Now coming to aggregation criteria. If two segments, that means you have got two CODMs. You have got two CODMs, CODM 1, CODM 2. There are two segments whose operations are similar. Economic environment in which the business is done is similar. Then your target audience is similar. Like this, you have multiple parameters. In all these circumstances, if you have similar characteristics, if two segments have similar characteristics, standard says even before testing for your 5 tests, that is 3 10% tests, 1 management choice, and lastly 75% tests, you can aggregate such tests, such segments, and then test for your 10% test and any other test. And after testing also, if you feel some other segment can be clubbed along with these, even then you can again test for you can again go for aggregation criteria. So that means under Ind AS you can go for aggregation criteria twice. Once before the tests are conducted, once after the tests are conducted, you feel two different segments are not getting recognized in the report. Hence, I would like to club these and show as one segment. That is what we call as second aggregation criteria. I'll give you with an example, then you would understand this better. Say, I have 10 segments, A, B, C, D, E, F, G, H, I, J, whatever. Okay. Now, out of the segments, A and B have got similar characteristics. Okay. So what I did is, I have combined these two and tested for segment reporting. This became reportable. Take it. C did not get reportable. D got reportable. E did not get reportable. F did not get reportable. G got reportable. I got reportable. So what are the reportable segments for you? A, B together 1. D is 1. G is 1. I is 1. Now AB is already a aggregated segment. Now second time after segment reporting is tested for, what standard says is all the other segments whatever you have, that means C, D, C, E, F, H, J, all these segments together should be shown as one segment. So what happens is your segment report will be holistic and your reconciliation will be very less, because whatever numbers you have in your P&L and balance sheet will get reconciled here completely. That is the difference between AS and Ind AS with respect to segment reporting. So broadly 3 differences. One is aggregation criteria. Second is categorization of segments into primary, secondary, all that does not exist under Ind AS. Third, identification of segments is completely based on chief operating decision maker. Under AS, it is purely based on nature of business, product lines, and all that stuff. So with this, we'll stop here today, guys. Tomorrow we'll pick up few more standards and try completing CA final standards by tomorrow, so that day after tomorrow we will start consolidation and finish off. Then we will go for intermediate standards with differences with Ind AS and IFRS. And by the way, IFRS comparison with Ind AS, no differences at all in segment reporting. Okay. So with this, let us stop here. Thank you. See you guys tomorrow.